Hello and welcome to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we will talk about understanding chart patterns. So the first thing you need to understand is, what is a chart pattern? Well, a chart pattern is just a group of candlesticks or bars, if you're using those, that form a larger pattern. So here's an example. You can take this brush here, click on rectangle, and by dragging like this, notice how price had gone back and forth between two levels. Now I'm going to extensively call this 1,000 and 1,300 in Ethereum. Not worried about the minutia of it right now, but what do you see? Well, you see a rectangle. Another one that you could point out on this chart is a triangle. This is what is known as a descending triangle. It's a very bearish or negative pattern. And you can see that we did, in fact, break down from there. So those are a couple examples of chart patterns. Chart patterns are just like an amalgamation, a grouping of candlesticks that gives you a bit of a heads up as to where the markets may go. So most patterns will give you a direction, or they will give you a certain measuring stick, like how far they should go. And I will go through all of those as we go through the pattern. But for example, so this is the descending triangle. Well, what this tells you is, and this is just really quick 30,000 foot view, tells you that the sellers are becoming more and more aggressive. You know, the buyers, the support for Ethereum is right around here. And once we break down, well, that tells you the directionality. But with this pattern, and a lot of patterns, not all patterns, but this pattern, you take the top of the triangle and you measure down, and that's where you expect the market to go. And it did. What you'll find is a lot of times it'll overshoot, but that's your measured move once you break out of that triangle. You should think of a chart pattern perhaps as consolidation. It's just the market trying to make up its mind. It's kind of leaning in one direction or the other. Or in the case of the rectangle, it's trying to decide whether it's going to go higher or lower. You know, neither the buyers nor the sellers are winning there. And again, don't worry about the exact chart patterns. Just understand that they give us a heads up. We'll go through plenty of those examples through this course. You need to take a look at lows and highs when you're looking at the market. So, for example, this was a recent high because we had broken higher, just as that was a recent low. That was a recent high, recent low, recent high, recent low, recent high, recent low, recent high. A trend is simply a matter of, are we getting more higher highs and higher lows in an uptrend? So it would be something like that, you know, like if you had a line chart, notice how price rises over time. Or are we getting lower highs and lower lows, which is a downtrend when price is falling? There's also sideways or consolidation, like, for example, down here in this rectangle. So there really is no trend. We're just kind of killing time. So be aware that there are three different types of trends. A lot of people get hung up in the minutia of a trend. You know, well, it's a 4-hour downtrend, but it's a daily uptrend. It's a weekly uptrend. You're going to save yourself a lot of headaches and recognize. So like here, this is the daily chart of Ethereum. There's the weekly chart. So you can see for the longest time, we were in an uptrend. Let's take a look at a market that's maybe not quite as crazy as crypto. Let's just take a look at a market in the dollar yen. Okay, so go ahead and remove these drawings. But you can see it's been pretty negative as of late this week. But when you look at it, it's still in an uptrend. There's really no two ways about it. Now, there are some people who trade on the hourly and go, wow, look at this major downtrend that's forming. It's a short-term blip on the radar. So the key part on trends is pay attention to the highest time frames. And then you drill down to smaller time frames to kind of fine tune your entries. There are market sentiment that you have to take into consideration. So in this case, this is the dollar against the Japanese yen, as the dollar has been just pummeling the Japanese yen. Market sentiment is very poor on the Japanese yen, very bearish, despite what we're seeing right as I record this. You know, for almost 2 years, it's been straight up in the air against the yen. So that's a bearish sentiment. There is bullish sentiment for the US dollar. Again, this candle notwithstanding, and that candle does not change anything. Swing high, swing low. So in this case, that's a swing high. We pulled back to a swing low, swing high, swing low, swing high. And the beginning of a downtrend could form if we break down below the swing low there. Again, not going to hold my breath. So you'll notice that we have pulled back a couple of times. But really, even as crazy as this move has been, especially in the last few hours as I record this, you really don't have a trend change until you break that swing low. And even then, nothing's a guarantee. It just puts probabilities in your favor. So that's another 900 pips. That's a huge move in the Forex markets. So a lot of people, unfortunately, will see something like this and start shorting like crazy. And yes, there's short-term money to be made, but the real money is to be made with the longer-term moves. So there are such things as upward and downward breakouts that you'll need to be aware of. So this is a trend line, and we'll talk about that here in a minute, but or in a couple of videos. But it suggests that every time we reach this line, sellers come in and push the market lower. Well, we have broken out to the upside. Is it a trend change? We're right on the border, because there's a swing high there, of confirming everything, and it could be. Longer term, is it a trend change or a correction? Well, we don't know. There is an argument to be made, and you'll understand this as we go through the course, that maybe we could go as high as here. Well, if we go up to there and pull back, it's still not a trend change. But the intermediate trend certainly looks like it is trying to change. We're not there yet, but we're getting close. Pay attention to that swing high. There's also one there as well. There is a fine line between trend changes and corrections. And there are a lot of tools out there that you can use to kind of help you with that. And again, that is further in the course. There are also what is known as false breakouts. So, and false breakdowns. So notice how, let me go to a smaller time frame. 4 hour. There we go. 4 hour chart. So notice how we had been kind of going back and forth here in this little area, and we broke down. Well, that is a confirmed breakdown, or in the other direction, it would be a breakout. But sometimes you get what looks like a serious breakout, and it's a fake out. So this is a pattern here known as a W pattern. And you can see why. And a W pattern is considered to be very bullish. It signifies a reversal. It's a couple of lows and then you break higher, but it was a false breakout. We broke out just a bit and then fell right back down. There are some ways to pay attention to that as well, and perhaps avoid that trap. If you took this trade, let's just say you did, based upon the W pattern, you would have had to been very weary of this area here as potential resistance, which is what we'll talk about in the next video. So that could have been your target, or that might have been an area that said, you know what, it's not worth the risk. Now, I told you that some of these have measured moves, you know, these patterns. Well, you're supposed to basically double the size. So it was a valid signal of this W pattern, but it stopped right where you would. So it just kind of depends on how you took a look at it. You don't want to get stuck in a false breakout, as soon as a pattern kicks a signal off and then it looks like it's going to go against you, it's time to get out. You have to take the small loss. That being said, sometimes patterns that fail are signals in and of themselves as well, if you think about it. When it looks like the market's leaning in one direction and then it just suddenly fails, that is something worth paying attention to. So there are a couple of different ways that you can look at various consolidations. So let's just take a look at a stock here. Meta or Facebook. Here is a pattern of a rectangle. You can see banged up against it 3 or 4 times here. And in this case, the market had been falling, right? So we get into here. And the question is, when we go sideways, is it what is known as a continuation or is it a reversal? Well, in this case, it was a continuation. You can see just how far it had dropped. That doesn't always play out, though. Sometimes the pattern can be a reversal. So as I zoom into this here, this has several of what are known as hammers. You could make a argument for what is known as a very, very ugly inverse head and shoulders. And that's a reversal pattern. And you can see we did, in fact, reverse. So, and we will talk about all these through the course. Just keep in mind, you need to understand swing highs and swing lows because they tell you about the structure of the market. When the market, and the higher the time frame, the more important they are. So when the market rallied, broke above this swing high here from here, the trend was completely changed. We pulled back to this swing low, broke this swing high, went higher, and it goes on and on. Keep in mind that there are a lot of tools that you can throw on top of these charts to help you out, and that's part of this course as well. So make sure that you understand the concept that we're looking at. We're looking at shapes on a chart to give us an idea of where momentum may be heading. That's the biggest takeaway. In the next video, we'll take a look at mastering support and resistance, which is the foundation to almost any technical analysis trading system you will run into. Hello and welcome back to Chart Pattern Trading Masterclass by Wealth Education. In this video, we'll talk about mastering support and resistance. So support and resistance, you'd be hard pressed. It's not completely impossible, but you'd be hard pressed to find a technical analysis system that doesn't take support and resistance into account. Support and resistance is by far probably the most widely followed thing on charts. So it makes sense that you pay close attention to it, because if you do not, you run risk of ruin. Support is where the market supports price. Resistance is where the market resists price. So pretty straightforward, really. Notice as I mark on the chart some of these levels, and we'll talk about support first. Notice how the market did not want to break down below that area and it bounced from there. Notice how you could say the same thing about this area at least twice. This happens to be Tesla, but this works the same on any other asset. So let's take a look here at the idea of resistance. Now, resistance is where the market is resisting price going over. You can see that we tried to get up here and we ended up failing twice. That is the market resisting breaking above there. There is a slight difference between a swing high and resistance. Resistance is an area that has proved itself. Like a swing high is just an area where we swung up to and then we broke down. Just like this potential swing low here, is it support? I mean, it could be, but it turns out that it isn't because notice that the market just kind of slipped through it. So that's your basic um, explanation of support and resistance. And the thing that makes support and resistance so important is that it gives you a heads up as to where you may see buyers or sellers come in. Doesn't mean they have to, it's just where they have in the past. What causes support or resistance to form is typically money flowing into the market. So, for example, this resistance area here, there were people willing to dump their stock, in this case, again, Tesla, or even short it in this, say, $310 range. So that forms resistance. There were buyers and they sold to them, and then there were buyers and they sold to them. And then the sellers got more aggressive, finding buyers at lower prices, and then they continue to push things lower. The same thing can be said if you're buying. There are value hunters down here that want to jump into the market, and they did 3 or 4 times on the way back up. And that's how you have to look at it. You have to look at it. It isn't quite right to say there's more buyers than sellers. It kind of is. It just means that, like in the case here, the sellers were more aggressive. So when price started dropping, they were willing to sell, keep selling, and there were people willing to buy, but they were much more aggressive about it. They were reaching down, if you will, to meet those buyers. So how do you draw the lines? Well, it's really quite easy. There's a trend line tool over here, a little menu. You click on this arrow and you go to horizontal line and you just click it on the chart. Notice there's a bubble. You just hold your mouse down and drag it back and forth. So this is our resistance area. You mark that with a line, for example. That's our support area and resistance. And that brings up the next point. Support and resistance tends to have what is known as market memory. So what I mean by that is notice how this was support, that was resistance, this was resistance, this was resistance. This was support, but it was resistance here, and it was support there, and it was resistance in this area. It was support there. So the best way I know how to describe this is through the prism of a real world example. So let's say you have a building, and let's just say there's 3 stories, 3 poorly drawn stories. So why would there be support and resistance market memory? Well, if you're on um, floor 1 and you're a buyer, this is your resistance, it's your ceiling. There are sellers there. Well, what happens if you jump up to floor 2? Floor 2 now sees that as the floor, that same level. Why? Well, it's the floor because think about it this way. If you were selling here or you were betting on the price going lower, if it comes back and you're break even after losing a bunch of money and you can get out relatively unscathed, you're more than willing to buy your short position back. Just like if you were up here and you break down, that becomes the ceiling. Why does it become the ceiling? Same reason. If you were a buyer up here at this point and price went up and then fell back down, if it comes back here, you're more than willing to sell your position to get out of the market. Another thing that causes this is that people understand that the markets have made a move. So in this scenario, if you see the market break from the first floor to the second floor, or let's just say 125 was major resistance, you see it break above there, but it pulls back to this area. Not only are those people that were betting against the market, betting the price was going down, willing to get out, thus buying the position, buying back their shorts, you may look at that and say, hey, I want to get involved. And it's come back to the original breakout point. So those who missed everything here will jump back in. So that's part of the psychology. There are different ways to address how to identify major support and resistance levels. One of the easiest ways that I know, like take for example here, this is one. This is parity. This is an area where we've seen buyers and sellers in the euro. Let's go ahead and put in a couple of round figures, big numbers, 110. Let's see if that has any effect. You can see that buyers and sellers have been there. This is the daily chart. Let's go to the weekly chart. You can see that the market has flipped back and forth at this area. Is 110 a major area? I'd postulate kinda. Let's take a look at 105. 105, I think, is even more important. You can see that we bounced from there 3 times, kind of consolidated there, and then broke down. Let's do 120. You can see 120 has been important multiple times. Now, I will also point out it has gone over there. Like in this area here, it got all the way up to like 123. Well, that comes down to that false breakout scenario. Plus, you have to understand that it's an area where something can happen. It's not something that has to automatically happen. So like in Ethereum, we go back down to the daily chart, 2000, probably an area that a lot of people would be looking at. And you can see it has offered support and resistance, but we sliced through it a little bit. You can't just go, hey, it's right on the money at 2000. I should short or I should buy. That's where you look for the patterns. So the idea is you're building a foundation, and it doesn't have to be these round numbers, but it just seems like they repeat time and time again. So for example, 1330, you can make an argument that somewhere around 1375 makes more sense for support and resistance there. You can see where it's offered both. But the idea is you are trying to find these areas where the markets react to. And then look for a pattern, look for some type of confirmation and take your trade. It gives you an idea of where things could happen. Furthermore, let's go ahead and go back to our Ethereum example. Another thing that it can do. So let's just say you're looking for a signal there, and I happen to see one, and I definitely see one there. So you're looking for various areas that could be targets. If you got in over here, you'd recognize this is an area that could be a target, and you can see that's exactly where it went. It did go lower, granted, but it spent a long time going sideways there. So not only does it give you an indication of where you might want to get involved, it can give you an indication as to where you're going. So in the next video, we'll talk about trend lines and moving averages, two very commonly used tools in a trading system. Hello, and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we're talking about mastering trend lines and moving averages. So a trend line is the same thing as the horizontal support resistance lines that we had drawn. Comes from the same menu. There's your horizontal lines. This is the top one on the menu, and they are drawn very easily. Click one spot, drag to another, click it again. There's your trend line. The idea behind a trend line is it is where buyers and sellers are coming into the market. So for example, take a look at that. This is the Qs, and this goes back 2 years. Every time we touch this trend line, we bounced. So traders will use it as an entry tool. Sometimes they'll use it as a tool to add to an already existing position. And they quite often will use it as a tool to determine when the trend is over. Notice how we had bounced from this line. We broke through it, entering a downtrend, retested it, just like you do horizontal support resistance, and then finally broke down. The higher the time frame, the more relevant the trend line is. So, for example, let's do dollar Canadian dollar, and let's go down to the 30-minute chart. This trend line had started. It offered resistance. Now, you want to see at least 3 candlesticks hit it. There's multiple ones there, multiple ones there, multiple ones there. But notice how it did get broken through relatively quickly. And that makes sense if you think about it, because it takes less effort to make that trend line as opposed to, like, say, over 2 years, like we saw in the Qs. So the idea is once you break through one, and a lot of times people wait for a candlestick close above or below it to determine whether or not it's holding or it's being broken out of. So like in an uptrend, let's do some crypto here, and an uptrend like Solana, let's just say on a 4-hour chart, we're in an uptrend for a while. You know, things are looking a little better. We finally break through it. Well, once you break through that trend line, you know that the trend is changing. Just like you could have made an argument for a downtrend line here. Touch, 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 broke above there, came back, retested it, and then took off to the upside. So it works the same way as the horizontal lines do. The other thing that you can do is use moving averages. So you come up here to the indicators, click on this, and you type in. Now we happen to have them moving average exponential, but you can type in moving average, and then there's a bunch of different types, but we click on moving average exponential, and you can see it pops up there. I click it again, and I click it again. You can add multiple ones. There is an eyeball where you can hide it. So let's go ahead and hide for now. Let's switch to currencies. They do tend to be a little bit more stable. Not always, but they do tend to be. So this is the New Zealand dollar. We remove the drawings here. This is a nice uptrend line on the 4-hour chart for some time. But again, we're still very much in a downtrend. So you could look at the downtrend line that is forming right there. So you could say that you would expect to see some selling pressure in that area, right? Well, let's go ahead and show some moving averages. Let's click on the wheel for the settings. And this is the 9. So what the 9 moving average shows is a line, as you can see, that follows right along with price. Now, what this is would be a representation, like right here at this part is a representation of the average price, in this case of the last 9 candlesticks. Now, it's an exponential moving average, so it's not a pure average. It places a little bit more weight on the calculation for the last couple of candlesticks. It just makes it move a little quicker. So let's go ahead and change this to the 20. So this would just be 20 candlesticks. And notice how it shifts. It smooths out quite a bit, and it tells you that the average price is dropping. So you're in a downtrend, at least for the last 24-hour candlesticks. We go to the daily. You can see it's much smoother. The 20 just started to turn higher, so it shows that the average of the last 20 candlesticks is rising. Go ahead and change this to 50. Now, 50 and 200 are kind of standards that people use a lot. And the reason being is it goes back to the old Wall Street days, 50, roughly 50 trading days in a quarter and 200 in a year. Um, you can see that it's much slower to react. And a lot of times what you see is the 50 with the 200. Um, so let's make the 200, actually, let's make the 200 blue. Let's make the 50 red because it's quicker. So there's the 50. And let me release the blue. And you can see how the longer term trend is definitely to the downside as well, although the 50 is starting to turn higher. They quite often are used as dynamic support and resistance, not always. And it's just a general guideline. Really can be sloppy, do horrible job in consolidating markets. But one of the things that moving averages going sideways can do is tell you when things are going sideways, which means that you should be looking at consolidation. So people will use them to identify uh, trends and potential dynamic, in this case, like resistance. You can see it has offered resistance on the way down. Let's go ahead and switch over to crypto, Bitcoin, kind of the same thing here. Some some indicators, some moving averages, numbers and stuff work better with some markets, and that's a bit of an experiment. But you can see like this particular market here, Bitcoin's very heavily retail driven at that point. So they were all following the 50-day EMA. Same thing over here on the way back down. With that, it does make a lot of sense in that particular market. But when you get, in the stock market, like the 200 seems to be important. The 50-day EMA, not as much. So the 200, a lot of times people will just say, well, we're above the 200, so therefore we're in an uptrend. On this Apple chart, you could have taken this and gone right along with this trend line. You can see everything's holding as great support. Notice that the 50-day EMA crashed below the 200-day EMA shortly after the breakdown. That's a bad sign. Doesn't mean anything has to happen, but it does suggest that perhaps the momentum's dropping. It's actually what is known as a death cross. When the 50-day EMA drops below the 200-day EMA, it suggests that you could be entering a bear market. The opposite is true. When the 50 breaks above the 200, it could be a bull market. It's what is known as a golden cross. And you can see clearly that was the case from 19 to 22, 2019 to 2022. The idea being the 50-day EMA is shorter term momentum. So if it is breaking above the slower momentum, the 200-day, then that means we're starting to see an impulse to the upside, or of course, vice versa. Moving averages are a tool. That's all they are. It's difficult to trade based solely upon them, but you will see plenty of examples of me looking at a chart with a pattern with moving averages going forward. I just kind of wanted to give you a quick overview of what they are so you know what I'm talking about. In the next video, we'll start talking about momentum indicators, such as RSI, MACD, looking at overbought and oversold conditions. Hello and welcome back to Chart Pattern Trading Masterclass by Wealth Education. In this video, we'll talk about mastering momentum indicators. So there is a term called momentum, which traders use quite a bit. And momentum just means exactly what you think it would. Whether the market is going sideways or if it has true momentum, up or down, it really doesn't matter. Both have momentum. And you have to ask yourself, is the market, so like, for example, there is bullish momentum longer term on this US dollar South African rand chart. there's bearish momentum to the downside um, over the last week or so. And with that being the case, you need to understand momentum and whether or not the market's actually moving in one direction or the other. There are indicators that people will use. There's a couple of really common ones called MACD, moving average convergence divergence, and the RSI, which is relative strength index. There is a and put on relative strength index. So there is a purple line here that pops out or below the range here that is marked between 30 and 70. And the idea is that anytime you see it pop above, the market's overbought, perhaps due for a pullback. When you see it break below, it's oversold, perhaps it's due for a bounce. Now, some people use the purple line, which is just the usual purple line. Some people use the RSI based moving averages. For the simplicity, we're just going to use the actual RSI line itself. That's how most people actually use it. So just be aware, you may have to go into the settings and get rid of that moving average on your TradingView platform if you choose to use the RSI. So anyways, that being said, you can see that we had broken down below the range of normalcy, if you will, into an oversold condition as the dollar fell against the rand and ended up doing that. We touched this right here and then pulled back. Now, notice we did rally from here and we didn't go into the oversold condition. That does happen. I mean, it doesn't mean that it absolutely has to happen for the market to turn around. It just gives you an idea of when things may have gotten a little too far ahead of themselves. So like right here, you can see the market was overbought. Now I will put the moving average convergence divergence indicator on, and it works in a similar set of circumstances. You've got a zero line, just like right in the middle here. You get a histogram and you get moving averages. So when the moving averages are well above and then they cross, it suggests an overbought condition. Notice it's right about the same time as the RSI did, maybe a couple candles later. We crossed here, but we weren't into an oversold condition. And the main reason I have both of these on at the same time is a lot of people will use them simultaneously. Oversold condition in the MACD, and then the moving averages crossed. When they cross like that and start heading in the other direction, that's typically a signal. So that would have been a really strong buy signal. There is something called divergence that people pay close attention to. So divergence is just simply when price is going one way and the momentum indicator is going in the opposite. So, for example, if price is continuing to rise, but notice how, so like here, price was rising. Notice how momentum was dropping. So your RSI and your moving averages were dropping. A lot of times, this is where the histogram in MACD comes into. A lot of times people use the histogram as a sign of momentum slowing down. So the histogram is a representation of how far apart the moving averages are. So the wider apart they are, the bigger the histogram gets. Notice here, price is rising, histogram's shrinking, and then you do in fact get a bit of a pullback. It's not a massive divergence, but little hints like that can give you a bit of a heads up. Let's go ahead and go into the crypto world here. We'll do Solana. So overbought condition right there. You started selling. Notice how price was rising rapidly, the histogram was dropping. That would have been a little bit of divergence. Let's add the RSI back on. You can see we were definitely overbought there, kind of drifted over and started falling. Oversold condition right here led to a short-term buying opportunity. Notice though that the moving averages didn't actually cross again until here once we got into the normalcy. So that shows you a little bit of a lack of momentum. And that's exactly what happened, which kind of sputtered out. Overbought, overbought just before it. So what you should notice is that we were peaking right here in the RSI, but the histogram and the RSI started to drop while we went higher for the next couple of candlesticks in Solana. And finally, let's go over the stock market and see if we can find an example here. Let's do AMD. So I see a pretty significant divergence. Price is going higher right there. Notice how the histogram is dropping and the RSI are dropping after being in an overbought condition. Well, that tells you that you are A, overbought, and B, running out of momentum. So these indicators can give you a bit of a heads up as to, when momentum's running out or when it's due to flip in the other direction. Conversely, you're in an uptrend like this. Notice how the RSI and the MACD are pretty quiet. That's actually good news, especially in the stock market, because volatility tends to be a killer for price. So in the next video, we'll take a look at mastering volume analysis. Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll talk about mastering volume analysis. So trading volume, number one, you're not going to get it in Forex. So the problem with Forex is it's completely decentralized. There's no real actual exchanges. It's all done through dark pools and liquidity from basically a handful of banks. So in that scenario, it's not going to be much use. However, in the stock market or anything that is traded on an actual centralized exchange like crypto or stocks, you have the ability to track volume pretty accurately. The volume of crypto might be limited only to that particular stock or exchange, but it at least gives you an idea. So, having said that, trading volume tends to pick up when momentum picks up or volatility picks up. And this can be worth paying attention to. So let's go ahead and click on indicator volume. You can see there's a series of bars here. And the one thing that you'll notice here in NVIDIA is that volume does tend to be relatively stable. This is a high cap stock. This is a high volume stock, so that should not be a surprise. But notice this day here where we gapped lower and there was a huge red bar. Well, what does that tell you? That tells you that perhaps, we don't know for a fact, but perhaps we're going to continue to go lower because there was a huge push to the downside. Basically, more people were involved selling the stock. Just as over here, we had a big spike in green, had a little bit of follow through, failed at the next resistance level, but you get the picture. So it does undulate. And you can see that occasionally there's a huge spike like that, pulled back, rallied, but then we had a huge spike again. So let me go through a handful of stocks here and we'll just kind of see how things play out. Big, massive gap lower for Facebook or Meta. And you can see that kicked off the next leg lower. Big, massive spike. Here in volume, you can see we've gapped lower. We're trying to fill that gap, but here's something that I would pay close attention to in this particular scenario. Notice how there's a lot of volume to the downside, but to the upside, not so much. So, what does that tell you? That tells you that people are much more confident selling than buying. Most of the time you're going to see this type of action where there is some difference, but there aren't major differences, right? But when you see a huge spike, then you need to pay close attention. And this is true on hourly charts. Big spike there kicked off a major move lower. Let's go ahead and keep looking through the stock world here. Coinbase Global. So again, lower volume than Facebook, but notice big, big, massive spike. And then we pulled back. Then the next candlestick here, this one was a big, uh, massive spike in price action. And while the candlestick was green, it was a gap lower. So yes, it ended up positive from where it opened, but it opened much lower. So you kind of have to pay attention. You can't just go by the color sometimes. Notice we came up, we filled the gap. Notice the volume's dropping. Interest is waning. You can see we start to fall. So quite often you will see what some people refer to as a U pattern like that. That can be a continuation or it can be a reversal. What you need to pay attention to is the fact that we're at another extreme. There's also something called an inverted U, which is pretty much what you would expect it to be. It's just a hump, really. So you could make that an inverted U, for example. Notice how volume is picking up, spiking, and then it keeps dropping. That is a hint that perhaps trouble is on the way. So you can use volume to measure momentum, to see the strength of a trend, as long as there's decent volume. Although the reality is a lot of, especially bigger stocks, they look quiet. Look at how that went higher, and we didn't see massive surge. There was a massive surge there on this candlestick, and then the rest of it was. I mean, there were some bumps along the way, but it was pretty straightforward. Less volatility, higher pricing, typically, not always, but that's typically the case. The ability for volume to confirm like a breakout or a breakdown signal is certainly something worth paying attention to. So this is what is known as a gap and go. So this was a gap at the open and then it took off. Well, look at all that volume. Well, of course it continued higher. Now, ultimately it pulled back, but that gap and go pattern worked out. Gaps tend to get filled. So here's a massive gap. Right here at the top, we formed a fairly voluminous candle to fill that gap, and then we continued down trend. There are other ways that you can look at volume for breakouts. Actually, let's go back. Let's go over to crypto. So Bitcoin dollar. So here's an example of Bitcoin consolidating right here in like a rectangle. Notice this candlestick here saw a bit of volume, but when we came back, we struggled a minute. And when we came back to the same rectangle, notice this candlestick kicked off a rally. Um, that's typically how people will use it. A little bit of a double bottom here, which is the pattern where you test the bottom twice in a row and it bounces. Notice here, big red candlestick, although should be noted that it was much deeper red than when it closed. So a lot of volume, people buying later in the day. Over here, we had another pickup in volume. So that's a sign that perhaps we are ready to continue going higher. There's one of those U patterns. This is an inverted U pattern over here. You can see that the market kind of drifted a little bit lower after it. So, I mean, volume's important, but I wouldn't necessarily say that it is the be all end all. It's something that helps you with other signals. So, like a pattern, like a rectangle, if you break out of it and you have volume, that's a good sign, that type of thing. If volume starts drifting lower and you're a little bit overbought, you've been going straight up in the air. So, let me put volume back on here. Notice this big, huge stretch in volume, big, huge stretch in volume, big, huge stretch in volume, and then we're just kind of drifting lower. Well, we got a pullback. That really, if you think about it, shouldn't be a huge surprise. Um, and you try to track that with like the RSI got overbought here and here. You can see that you had a little bit of pullback. In this case, was it a shorting signal? Maybe, maybe not. But what it could be is a signal to take profit. So that's another thing too that you have to look at it through the prism of. In the next video, we'll hit on mastering trading psychology. Hello and welcome back to Chart Pattern Trading Masterclass and from Wealthy Education. As you can see, I've got the chart up, but this is going to be a little bit different video in the sense that it is about psychology. You need to understand that psychology is really what a chart shows. So, for example, I've got this daily chart of Ethereum here, and it could be anything. It doesn't matter. And I'll even simplify it. I'll bring it down to a line chart. So what you're seeing here is how people feel or think about Ethereum. You're seeing major spikes higher, major spikes lower, depending on fear and greed. If people think that an asset is going to go to the moon, or whatever expression they want to use at that moment, they will buy it. You can see that was clearly what was going on here. This was greed. Also, you have to understand that moves like this don't really happen very often. And when they do, they always pull back because sooner or later you run out of people to buy the asset. So you need to look at it through the prism of, can it really continue this type of momentum? That's a lot of greed and that's a big sell off. That sell off is partial taking profits. It is partially fear driven. I mean, imagine that you got in and you gained $1,000 per coin in like a week. Well, that's a huge move percentage wise. That's almost doubling at this point, and that's something that can't last. So those are your movers of the chart. So I've got dollar Swiss. Let me get rid of this support and resistance lines that I had drawn previously. And let's go to the weekly chart. And you can see big greed, big fear. Now, you need to understand that most of what you will be fighting in the markets, stock markets, um, crypto, futures, currency, or anything else, honestly, your biggest fight is going to be with yourself. So, here's the famous AMC trade. That was greed. That was insanity. Go ahead and go to the daily. I mean, that's not a normal move. That, and in a sense, that was fear because part of what was going on was people who had shorted the market, in other words, bet on the thing going down for so long, suddenly found themselves in what is known as a short squeeze. And a short squeeze is the market, all the short sellers having to buy it back. So on one side of the aisle, you had greed. On the other, you had fear. And that's a perfect example of how markets behave. Because you had all of those people that were sure the market had to buy it back, and all of those people that were greedy at the same time jumping in. And you can see everybody's lost money since then. That got long in AMC that didn't get out and take their profit. So that brings me to the next point. You need to understand that you need certain rules. You don't just buy because something's going higher. There are people that thought this was going to go to I don't know, infinity, and there were people out there buying and they lost a lot of money. So what you want to do is set up like a technical trading system like we're going through in this class. You decide that, you might have one play that you like. Maybe you like it when rectangles are broken out of, whatever. And you stick with that and you stick with that one particular play. That will keep you from over trading. So what you're looking for is a setup of a specific type. And that's all you trade for a minute. And then you add and you keep adding on. And then eventually, maybe you have five different setups that you're willing to take. And you have to be aware of the fact that not every day is going to offer their particular setup, and you have to be okay. And that's one way that you can overcome greed and overtrading. Another thing to overcome greed is a lot of times when you are in a big move. So, say you were in this big AMC move, somewhere along the line, you have to set stop loss orders. You should have one going in, but if you have seen this type of move, you have to decide that somewhere you're willing to get out and take profit. Even if it was just something ridiculous, like all the way up here, that's a ridiculous move in a stock. That is a massive gain. So when you're up here, you have to say, okay, I'll give it like a third back. And if it gets back over a third, then I'm just going to take my profit. You would have done quite well. So that's one thing that you need to understand about overcoming greed. And you don't move your stop losses. If you set a take profit order, you should follow it. Although in an explosive move like this, let's just say you got in and you thought you were going to go to here, right? But you happen to see the momentum really picking up and it's really taking off. Some traders would take like half of their position off and then move to their stop loss to break even and just kind of see how lucky they get, right? Sooner or later, though, you still have the same issue. Where do you take your profit? You have to figure out on the way up or just say, okay, it's blown through the ceiling here. Where am I comfortable taking profit? At the very least, you don't lose money. Now, there are a multitude of ways to improve your trading psychology. And this is one that I've used for years with any new system, any new market, because I have jumped from market to market, is get yourself comfortable enough to leave the trading platform. So let's just say you're trading euro yen and you see this setup and for whatever reason you believe that this is the top and we're going to start selling off, or in this case I would be more apt to buy the pullback because it's with the overall trend. So let's just say you buy it right here. Now it happens to be the weekend as I'm recording this, so price isn't moving, and you decide that your stop loss is 141 and a half. What you will notice is, depending on the size, you may or may not feel the need to watch the market the entire time. So you can start with, I'm just throwing numbers out here. It's going to be different for each account and for each person, but let's just say you start with something like $1 a pip and you're risking maybe 150 to pick up 400. Now that might be perfectly comfortable for you. And then if that's the case, if you go on about your day, you don't find yourself worrying about it or checking the platform every 10 minutes or whatever, maybe move up to 120, $1.20 a pip. Conversely, if you find yourself still a little bit nervous about it, bring it down to 50 cents a pip. You will notice the psychology changes quite drastically. You may find um, that, and most of the time you'll figure this out percentage wise, right? But I'm just using this as an example. You may also find that perhaps, um, go ahead and remove the draw link. You may find that this is a situation where you are comfortable with 0.5% risk. You may find that you are very uncomfortable with 75 basis points or, 0.75% risk between your entry and your stop loss. So I think one thing that people get very far away from is that when we go into trading to make a living. We trade to live, not live to trade. So my best advice and the best thing that I've ever done for myself has been kind of going back and forth with this. Other people of a different type of mentality altogether might be comfortable with 3%. Now, professional managers would never do that, but because the math doesn't work out in your favor of the long term. But having said that, it's going to come down to your individual psychology. I know some traders who only risk a tenth of a percent every trade. Now, a lot of times those guys will not have a target. So they'll risk a tenth of a percent, but they may be in this trade for 6 months because it blows past the target. Next thing you know, they've made like 5% on that trade. So a lot of it's going to come down to how you look at the markets and what you are comfortable with. There is no one size fits all. You should risk X amount of percentage. I know a lot of people say 1% and 2%, but the reality is you don't even need to risk that much if you are willing to hang on to gains. And most professional traders don't. So it's an experiment. You need to decide, hey, am I comfortable with $1 a pip, or do I need to think of it more along the lines of 0.25% of my account? And if you are comfortable, then maybe bump it up just a bit. Next time, instead of 0.25%, maybe make it 1/3 of a percent, 0.33. If you're not comfortable there, then somewhere in the middle of that is going to be your comfort zone where you're not worried about it. Because the biggest problem you're going to have is if you are not comfortable, you're going to do something to mess up the trade more likely than not. You'll jump out too early. Um, you know, you'll take losses that could have ended up being gains, that type of thing. The idea is you jump in the market and you have the ability to not worry about it. You just let the market do its thing. And from years of experience, I can tell you this exercise with position sizing, be it percentage or pip wise, is one of the smartest things I've actually done for myself. So, in the next video, we'll start talking about mastering risk and money management, which we kind of touched on in this conversation. So, we're just going to expand on that a bit. Hello, and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll talk about mastering risk and money management. It probably could also refer to this more or less as trade management. So, we kind of talked about trading psychology and how much you want to risk per trade. Now, you have to understand that every trade you enter is literally a 50-50 shot of which direction it goes next. There are ways to put odds in your favor. So, one thing that I would say is, this is the Australian dollar, but you can see since February 21 to November 22 year, that is, for the most part, you've made easier money on the way down. we're in a trend. So that's the first thing about money management and trade management, risk management that you need to keep in mind. You don't want to fight the market. Now, we happen to be in a massive move higher at the moment, as you can see, but I think a lot of people get stuck looking at the chart like this and going, "Oh my god, we're going to the moon," when they don't look at the chart like this and say, the Aussie has been stronger in the past, quite a bit. Um, Retail traders have a long history of trying to pick the bottom, and picking the bottom is a great way to get wiped out. Um, just simply put, you have to be very cautious because there are multiple times along this way where we bounced a bit. You can say, "Oh, look, there's a double bottom, time to start going long." And while that did work for a short amount of time, the reality is the trend changes in the forex market, and this is part of knowing your market, tend to only happen every 3 years or so. That's obviously not always the case, but that's about 3 years. That's about 3 years. That is only a year and a half, and this is a year and a half. But this, '02 to '05, or 1 to '04, sorry, '01 to '04 was an uptrend. We did pull back a little bit this year on '04 and then kind of consolidated, but '06 to late '08 was an uptrend. Had a massive sell off there. '08, well, we all know that was a financial crisis. '08 to 11, 3 year trend. Now, granted, you can't base everything on that, but that gives you an idea of why the trend matters. Um, I'll just go into it'd be a little harder with crypto because crypto's so new, but I'll just go into a stock, something with a long history of trading. Okay, Google. Google's been in an uptrend forever, right? So that being said, until recently, until late 21, for the most part, if you bought Google, you made money. There's been a couple of nasty little pullbacks, but you can clearly see that there's only been one way to trade this market. And there's always somebody out there willing to jump in and say, "Oh no, 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 this is the end." But they don't tend to be profitable. You can even look at this in indices, S&P 500. Yes, it's been a pretty nasty correction, but when you look at the S&P 500 going back to 79, I mean, you've still made most of your money on the upside. Does not mean that you cannot make money on the downside. It's just that it's easier. So that's the idea I'm basically trying to pound into your head here. So knowing this, if we decide to trade a stock, I'll pull up Nvidia here. You can look for different ways to take your profit or place your stop loss. So, this right now is going to come down to support and resistance more than anything else. So I'm just laying out quick lines that I see. And I'll clean them up here. So, for example, 165. Remember, it doesn't mean to the penny. It just means that's your general area. Let's see. So let's do 200 here. 120. Okay, so this is your weekly chart, and you can see that these are major weekly support and resistance levels. So if you break out above here, where's the next logical place you go? Somewhere near here. What you're looking for is some type of chart pattern, candlestick, something like that, that's going to tell you we're running out of momentum. Speaking of which, you can also add like a MACD. Well, the MACD is starting to cross here, and the histogram just went green. So that tells you we were oversold. We'll see if we bounce. Very possible that we do. it's been a pretty brutal sell off. So at the very least, you would think so. Alternatively, if we show signs of exhaustion here and we pull back, well, where do you think we're going? Well, maybe as low as 120. Now, I use the weekly chart because it's a little easier to kind of spot where we could go. But you can lay out your lines on the weekly chart, then take a look at the daily chart. Well, right here, you can see it's going to be a fight for this to break out. That's why I think it's such a big sign if we do. If we pull back, which I can't say that I'm expecting, but I certainly would keep my eye on, then it's possible we drop back into the 120 level. Or on the daily chart, you can also see that this area right around 140 has mattered. The trick is to find areas that have been important multiple times. Because if you start laying out like weekly, daily, hourly, etc., you end up having so many lines on the chart you can't do anything. But you can see 140 has mattered back here as well. So let me ask you this. If you are going to short this market, let's just say you get a signal to start selling. Where do you want to put your stop loss? Well, you put it above here. You put it up there because the market's going to have to break through that resistance to take you out. And you target down here. If you jump below there and you're still in the market, then you can move your stop loss up there. It's just a way of letting the market tell you when it's time to get out. And your job is to just sit on your hands and let the market do its thing. There are other tools you can use. So, um, for example, let's do Binance Coin. So, some people will use what is known as a Fibonacci retracement, which actually is uh, something we'll go into in more depth in the next video. But suffice to say, we're in a downtrend. That's your swing high, your swing low. You draw from there to there. 50% of the move is retraced. You form a candlestick known as a shooting star. You start selling and aiming down there. Where do you put your stop loss? Some would put it directly behind the Fibonacci level. Some would put it behind the one above it. This is thought of as dynamic support and resistance. The mechanics of it don't really matter. It just gives you an idea. Like from here, the 50%, or excuse me, the 38%, 38.2% is here. And we continued. So you can use a tool like that. And like I said, we'll go into Fibonacci next video quite a bit more. But really, it comes down to support and resistance more than anything else. You have to let it guide you in order to take advantage of buys and sells. You can also take a look at volume. There are going to be times where, so like this U pattern here and this sudden spike. So notice how we rallied right into this resistance here at about 170. We ended up forming what is known as a hanging man. That's a bearish candlestick. So you can make an argument that we peaked there and volume started to drift lower. Shooting star candlestick, very bearish candlestick. We did spike just before it and lost volume. So volume can come into play as well. More than anything else, though, I would impart upon you to pay attention to those support resistance levels because they tend to appear time and time again. They're not always perfectly laid out, but you can see this is an area where markets have reacted to, maybe not as strongly as there, but it mattered. This is a pretty strong area. So breaking through there, pulling back to there and falling again makes a lot of sense. You can say that we formed a double bottom there. We bounced, and went higher. That's an area that should be important. We had to gap below it to continue going lower. But it certainly had a nice bounce trade form from it. Now, as far as money management, like I said in the last video, it's going to be number one, it's going to be a matter of how much can you psychologically do. And then secondly, you need to worry about being able to deal with a string of consecutive losses. For example, if you are um, taking 16, or if you're taking 16 trades, statistically speaking, you will get four of the same in a row once every 16. So, statistically speaking, um, you would have the likelihood of four wins in a row, but you also have the likelihood of four losses in a row. So if you're betting a percent on each trade, you could lose 4% in a string of trades because you have a 1 in 16 chance of getting four in a row. Doesn't mean you have to get it this 16 trades. It's just statistically speaking. Um, that being said, every time you go further out, then you double the amount of times that you may hit that many in a row. So, for example, if it took five losses in a row to wipe out your account, you're talking it'll happen one every 32. If you decide that you want to make it so that it's even more difficult, you remove the drawings. The odds of hitting 100 of the same results in a row, be it wins or losses, is expressed mathematically. I don't want to get too far into the weeds here. Is 1 in 2 to the 100th power. What does that mean? Um, this is the odds of that happening. So, in other words, I still have more numbers to write, believe it or not. In other words, the odds of having 100 losses in a row, assuming that you have a system that is 50-50, comes out to that. It would be easier to win the lottery. So keep that in mind. Um, that's why a lot of people come up with 1%. Now, again, does it fit your psychology? Maybe, maybe not. Um, but that tells you how quickly things can change if you're betting, you know, one out of every 32 trades. If you're going to bet 20% of your account, meaning you would have five losses wipe you out. That is something that, is going to happen every 32 trades. So you're going to be in trouble. But if it's going to be something that, it's going to take 100 in a row, you saw that number. I don't even know what the name of that number is. It's so big. Obviously you're probably going to find somewhere in between that you're comfortable with. But nonetheless, that gives you kind of a quick overview of just how position sizing comes into play, just how it's all about stats. I mean, you have to assume that some of the best traders in the world actually, you're looking at a win rate of about 55%. Now, they overcome the statistical edge, and casinos would kill for that edge. But they overcome this statistical edge because number one, um, they let their winners run and they get rid of their losers pretty quickly. So some of these traders might have like a 1-to-5 ratio. Some might have 1-to-3, whatever. The point is that they are aiming for much more than they are risking. That's the other part of this that doesn't get talked about enough. So make sure that for every dollar or euro you risk, you're trying to get at least three. Um, I mean, bare minimum two, but the higher the number, the better. But you also have to understand that if you're going like 1 to 10, 1 to 20, you're going to have more losses. Um, but it is possible, it's statistically possible if you are going for 1 to 20 to only be successful like 10 or 12% of the time and make money. But you have to have the psychology to hang on for what will certainly be a string of losers in a row. So you definitely have to, this is kind of on you in the sense where the best thing that I can do is give you some things to think about and then some exercises, like I said, changing your position sizing and walking away from your computer and going on about your day and seeing how that plays out. Um, there are no two identical traders out there. There's an old study that people talked about where you could have two traders using the exact same system and one will make money and one won't. Well, it comes down to money management, it comes down to psychology, being able to hang on to trades, things like that. So in the next video, we'll talk about mastering Fibonacci tools, which I kind of showed you a little bit in this video. Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll talk about using and mastering Fibonacci tools. So Fibonacci is a somewhat controversial part of technical analysis. It is based on a mathematical formula that is found time and time again in nature. And it basically is a sequence of numbers like 1 plus 1 equals 2, 1 plus 2 equals 3, 2 plus 3 equals 5, 3 plus 5 equals 8. So what you're doing is you're taking 1 plus 1 equals 2. Then you take these two numbers and you get 3. And then you take these two numbers, you get 5. You take these two numbers and you get 8. And on and on. It's there are a lot of places in nature where Fibonacci ratios come into play. The golden ratio is 61.8%. So basically, what it means is that there's like an evenness of distribution of 61.8% of a particular number. So people will observe this like in crop circles, the bends in rivers, bends in mountains, et cetera, et cetera. Came out in the I believe 1300s on from a guy named Fibonacci, and he basically kind of came out with this pattern in Italy in the 1200s, but there's also signs that it came out in Indian mathematics is possibly as early as 200 BC. So we'll see. You also have Fibonacci sequences just showing a lot of changes in nature. Now, here's the thing. Fibonacci works because people think it works. Would probably be the best way to describe it. So for example, you'll notice that a bunch of numbers appear. Now, the first thing that I'm going to do is I'm going to show you all of the Fibonacci numbers that are available on the Fibonacci tool, Fib retracement tool. And there are other Fibonacci tools that you can use. So these are all the Fibonacci ratios that you can use on a retracement. So if I pull this all the way down here, maybe on the weekly, you can see that in a downtrend from top to bottom, you can see all of these ratios. Same thing in an uptrend. So you're just basically going from swing high to swing low in this case, because you're thinking, okay, it's a downtrend. Notice how we popped up here to the 50% and then fell off. Now, here's the thing. With Fibonacci, there's only a couple levels that people truly pay attention to. And that is going to be sometimes you hear 23.6. In general, not. Um, so you're getting rid of a ton of Fibonacci numbers. So 38.2%, 50%, 61.8%. Here's the catch with the 50% retracement. So we fell, we pulled back 50% of the time. That's an old Wall Street trick. It's not even actually a Fibonacci number. So Wall Street would do things like enter on a 33% pullback in that direction, thinking that the trend had asserted itself. If they didn't do that, they would do like 50 or 66%. Well, that comes out to roughly the same. But I've simplified the Fibonacci retracement tool for you for the numbers that people care about. You have to be cautious because some people will use Fibonacci in this way. So we put that one up. Well, that's a swing high there. So we put that one up. And if it pops up here, we've got this one and this one confirming both, depending on where you draw it from. And you got that. So that's 38.2%. You know what I mean? So you could go on and on and on and just really go over the top with it. So you have to be cautious. Fibonacci is something that can give you an idea of where support and resistance may occur, and therefore give you an idea of where you might want to look for a potential trade. They are not the be all end all of markets. We rallied here. We pulled back to the roughly 61.8% level. We pulled back there again, formed a double bottom, and then rallied. Again, not the be all end all of everything, but at least gives you an idea where people might be willing to get involved in. So let's go from Alibaba to something crypto. So you can see here that we blew through the 61.8% level. So it doesn't mean that it has to work. And in fact, it didn't there. Um, the problem is now that we're clearly in a downtrend, we pulled back to the 50% Fibonacci retracement level and then went higher. So you can see you can't just willy-nilly use Fibonacci. However, what you can do is look for some type of setup. So let me go down to the daily chart and see if I can find a decent setup. We turned around and we pulled back to the 50% right there. Is this a decent setup? I mean, maybe you would want some other type of um, confirmation. So there's the 50-day EMA. It's sitting on that. It drops down below there. I suppose you could do that. You could do, we rallied here. The momentum is dropping in the MACD. That might be a signal as well. Let's see, RSI. RSI really didn't tell you anything. Shouldn't be a huge surprise. It does need kind of an extreme. So, I mean, you can make an argument that it's kind of like a support and resistance line. It gives you a heads up as to where you might want to be looking. There's also, click on this, Fibonacci, trend-based Fibonacci extension, which is a Fibonacci extension. So you click from, in this case, swing low to swing high. And you can see that you can be aiming for, it's almost like you can think of it as a retracement and reversal. So we extended, we got all the way up to the highs. And let me see here, find a cleaner example. Let's do the Ethereum markets. Get rid of the drawings. So, what this represents is so that's 100% of the original move, right? And this represents a doubling of the move. So you pull back, and then at this point, you're looking, where could the market go? Could it go? Could it double the move? Well, we've already done that. Could it only be 38.2%, 50, 61.8% of the move? These are projected moves. You can, let's see, you can use it on a short term chart as well. So, of any drawings. So here's an interesting one. I'll do this on the hourly. It'll just be easier to show on the chart. You can see that we had a vicious move. And look what ended up happening. It came back here and then it tested that bottom. And then eventually it hit the doubling effect. And now it's much lower. So somebody who was using this to trade this probably would have had their target set here, their stop loss behind here, and maybe a second profit target there and a third profit target down there. It kind of comes down to what kind of trader you are. Typically you get one, maybe two. To get to the third or the fourth one is a bit of a stretch. That's a complete trend change. For what it's worth, this is actually a market that's in an uptrend. It just had a brutal couple of days. You could have also done this, and you can see that we did in fact hit the first one, didn't hit the second. Doesn't mean we won't eventually. So these are like areas of potential support resistance. You never really use them alone. You want to see some type of candlestick pattern, maybe an oscillator like MACD or RSI come into the picture and tell you the same thing. It's My experience has been you find a lot of luck with it because a lot of people use it, not necessarily because it has any inert value other than that. But that's exactly what you need to make a market. You need, if you're buying this pair, you need people to be doing the same. So it's a nice secondary indicator, maybe tertiary indicator, but it is useful in that sense. It's like anything else. It's like building a house. The more components you have of stability, the better off you're going to be. So if you have moving averages, you have Fibonacci, um, all moving in your favor, then yes, you have a real shot at um, being successful. In this case, you could even have a trend line. Did we break the trend line? Looks like we broke the trend line during the previous session. Again, trend lines can be drawn multiple times at multiple places. So maybe this is where the market stops. Right there was previous resistance, so market memory would suggest support. Again, a lot of this seems to be, there's a lot out there. But really, at the end of the day, it's about stacking the odds in your favor. So the more you can put in your favor, including Fibonacci, the better off you're going to be. So that ends module one, chart pattern trading foundation. In the next module, we're going to start taking a look at the most bullish chart patterns. Hello, and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. This is the beginning of module two, the most bullish chart patterns. In this video, we'll be talking about a double bottom pattern, or mastering it. One of the simplest patterns out there. One of my favorites, mainly because it's so obvious. A double bottom is just what it sounds like. Market falls, bounces. It's formed one bottom. It falls, it bounces again. It's formed a double bottom. So sometimes you'll hear it called the W pattern. It's kind of interchangeable, and you can see why. The idea is once you break above the middle part of the W, you go along, and now you can put your stop loss on the other side of it. You should get at least the height of the pattern. Some people will put their stop loss in the middle and aim for the height of the pattern, thereby making sure it's at least a 2-to-1 ratio. But realistically, a lot of times these double bottoms kick off a much bigger move than just the height of it as well. So there are a couple different ways to look at it. So you can see double bottom right here in the dollar Swiss, and we broke quite a bit of movement to the upside, right about the same height. We pulled back, formed another double bottom, and then really took off. So you can see the power of these patterns, mainly if for no other reason, everybody else sees them too. And that's a good thing. You want the market with you. 97.5, an area of obvious interest as we have moved along. So certainly makes a lot of sense. You could probably make an argument for a bit of a trend line there as well. If not on that one probably. So you see where I'm going with that. Let's go ahead and take a look at a stock. Let's do Hindalco. Here we go. So here's a nice double bottom. So the question is, why would you get involved in that? Well, there's nothing on the immediate chart that would tell you that. But when you look at the past, you can see that there was a significant amount of support there. This was one of many that we had tested. So a lot of times what people will do if they want to go long a stock, they will mark out levels that have been important multiple times in the past, and then they'll just wait for some type of confirmation. And you can see we didn't really get it there, sliced right through that one. And here we formed a double bottom. So, you can look at it through that prism. You can also, I'm going to take a guess here, but I suspect you could also say that the 61.8% Fibonacci is right there as well. Now, did it get its double bottom? Height? Well, of course. I mean, it got quite a bit more than that. Now, it took time. Again, these things don't necessarily move on your schedule, but it's been a pretty significant move higher. Let's take a look at crypto. Now, Solana, you can see, is in the midst of trying to form a double bottom. But here's the thing. It's not a double bottom until it breaks the middle of the W pattern. And you can see it's already starting to look a little bit limp. So by adhering to that, you will have saved yourself a lot of trouble. Plus, you have to look at it this way. Let's just say that this market went straight up, whatever reason, everybody in that area is now losing money and they need to buy back their shorts. So that's what you're looking for. Basically, you're looking for traders that are trapped. This was a double bottom, but it never kicked off. So these are false signals, or, not fired off trading signals. And those are important to understand what they look like as well. Here's one that did right here at 38. You can see, it did pull back a little bit, but then eventually took off, pulled back again, and then took off. So you can see just how important these can be. And, some of them are going to mean more than others. So let's take a look at dollar yen. Clear all my drawings. So there's a double bottom there. Now, they're not really close to each other, so it's a bit of a stretch. But here's one. Bounce, bounce. Right off the 50-day EMA. And more importantly, it suggests that we're going higher and we're in an uptrend. So that really, you're not even trying to find the bottom here. You're just trying to find the bottom of the pullback. And those are two distinctly different things that are worth um, differentiating. And on the daily chart, you can see it looks a little cleaner there. I guess that was the 4-hour chart, but the whole point is you're looking for where the market's not going to go. A lot of times where the market doesn't want to go, that's a huge signal in and of itself. So in the next video, we'll take a look at a pattern called the cup and handle pattern. Hello and welcome back to the Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll talk about the cup and handle pattern. So a cup and handle pattern is simply a pattern where price does that. So it gradually kind of turns higher, forms a little bit of consolidation, and then takes off. Now, what you like about this is, unlike the double bottom, it's a slow build up. So that means something's changing in the overall outlook. It isn't so much a reactionary move. It's a true kind of grind. You get a bit of a consolidation here in what looks like a flag, something that we'll talk about here in a few videos, but it's consolidation. So the market is drifting lower, rising, kind of taking a breath, and then it takes off. The idea is that you get the return of at least the height of the cup. Now, they call it cup and handle because it looks like one of those old teacups. At least that's what they say. So in front of you have a dollar Canadian dollar. You can see that there is one of those patterns there, like a U shape. And then there's a little bit of a consolidation and we take off. So the question is, do we get what we're looking for? And the answer is yes. Once we break out of this handle, we get exactly there and then pull back and then get more. You put your stop loss on the other side of this handle. Now, something that's probably worth pointing out here is notice that we bounced from the 120 level. It's a large round number and people will pay close attention to that. The momentum clearly has slowed down for the sellers. And we just see a nice sustainable rally. Does it last? Well, so far it has. It's a pretty nice move. You can see at one point it gained 20 handles. Of course, it was over the course of 2 years, but you can see that that did in fact get the ball rolling. So let's see. Let's do let's do Amazon. So Amazon on the daily, you can make an argument. And this does take a little bit of artistic license, admittedly, but you can make an argument for one here. Basically, you're seeing the market try to stabilize right here at $80. Nice round number. We break above the top of that and we walk right along with the 50-day EMA. That's not uncommon to see all of these things come together. And that's exactly what you want to see. There are, this is what is known as an inverted hammer. So breaking above that is pretty bullish as well. Keep in mind that when you look back through time, back here at the bottom of this, you can see this was an area that had been important. So previous support and resistance clearly coming into the picture. Now for crypto, you won't have as many examples just because crypto hasn't been around as long, but you can make an argument for that in Ethereum. And notice that it's right on top of support. So once we break above that, we take off. And go ahead and mark that. I am kind of zoomed out. It's a little easier to see on the higher time frames like this. But you can see that's what we've got there. This, again, you're going to have to probably look, if you want to find examples in crypto, probably on these shorter time frames. So here's one, 4 hour. We break above the 200 EMA and just launch. Another thing that I'd point out is we broke above 1300, which was resistance. So that all comes into the picture. And support down here at 1,000 had been tested a couple of times. You could even make this a double bottom. So you can see how everything kind of ties in together. Remember, you want to buy on a break of the handle, put a stop loss on the other side of it. That way, if you're aiming for the size of the cup itself, you're pretty much guaranteed you're aiming for about 2.5 or maybe even 3 to 1 on your risk to reward ratio. In the next video, we'll talk about mastering the inverted head and shoulders pattern. Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll talk about mastering the inverted head and shoulders pattern. So the head and shoulders pattern, which is what this is a derivative of, and we have a video on that in our next section, is when the market does this. An inverted head and shoulders is just that, it's inverted. So what does a market doing that tell you? Well, it tells you that you're heading in one direction. In this case, this is the head and shoulders. This is the inverted head and shoulders. You're heading in this direction and you rally. You're in an uptrend and you pull back and you rally again, which is exactly what you expect to see. And then you pull back and then you don't rally quite as much. It's a momentum shift. In the inverse, it's the exact same thing, except we're falling. So we're falling. The buyers come in, push it higher. The sellers take over again, push it even lower. We rally. And then this next attempt, we don't make quite as much of a low. And that gives you a heads up that something may be happening. It is called a head and shoulders because it's a head and it's got two shoulders. Inverse is just inverse of it. There is a built-in pattern measuring stick. So you take the neckline, this is what they call it, the neckline where the two dips meet. You measure the height from the neckline to the top part of the head. And then once you break the neckline, you are aiming for that same amount. A lot of times you just put your stop on the other side of the shoulder. So therefore you get it, it'll vary, but at least at like 2 to 1 ratio is what you're looking for. So really this is just a heads up, and it's not until you break the neckline. It's kind of a heads up that we're running out of momentum. So you can see that the dollar popped higher against the Canadian dollar, came down, made a low, made a lower low, failed here to make an even lower low. You can make an argument for that being the neckline, and something that you should be aware of. It does not have to be straight up and down. It can be tilted like this. You just take your trend line tool, you write that right when you break out of the neckline. We did pull back. You did have some uncomfortable noise here on the 4-hour chart, dollar CAD, but you eventually got what you were looking for and quite a bit more. And like with both of these patterns, yes, there is a measuring stick, so to speak, but a lot of times you'll beat that. You'll notice that the moving averages, once we broke out of this pattern, cross back over. So in this case, it's the 50 over the 200, but you get the idea. And it happened right around 129.5, 130. So that's an area of interest as well. Let's go ahead and take a look at crypto. Let's do Bitcoin. Clear all of my drawings. Hide everything except for the volume for now. So this is a failed inverted head and shoulders. I mean, failed as in it didn't kick off. But you can see that there are a lot of patterns that occur that do eventually lead to bigger moves. So in this case, you got a little bit of an inverted head and shoulders pattern here. Not a major one, but one that tells you that, hey, maybe we're ready to bounce again. And we, in fact, did get the target pretty quickly. Let me go ahead and get rid of my drawings here. You put your moving averages on, you can see we were right there at the 200, the 50-day EMA spread out. Another thing that might be worth bringing into the conversation, there was support there based upon previous resistance at basically 22,500. Okay, so let's go ahead and look at stocks. And let's just do, let's do Netflix. So Netflix, let me put this on the daily for now. So Netflix, you can see gapped lower. We made a low, made an even more low, or an even lower low, I should say, but failed to make a continuation pattern. And that kicked off this move. Pretty straightforward. We filled the gap. That's another thing, too. A lot of times these gaps, although they offer resistance, they do get filled. And that's exactly what this and that gap told you. It was an earnings miss, evidently, which is pretty common with stocks. Go ahead and put the 50 on, 50-day EMA. And you can see we broke just above it. Let's look at volume. We like volume on stocks with our moves because it's a central exchange. So you're going to have to kind of look at this closely, but you can see the volume did pick up right here as we were breaking out. It wasn't a massive spike like one of these, but it did show some effort. And that's really all you're looking for. So pretty straightforward. I mean, there's not a lot to say about this pattern other than it's a failure to continue the downtrend. Next video, we'll take a look at something called a diamond bottom pattern. Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll take a look at mastering a diamond bottom pattern. Now, a diamond pattern is simply a huge conglomeration of candlesticks that make a noisy area that then has a diamond shape to it, as you would expect. So really what you're doing is you're drawing trend lines around and trying to form a diamond pattern. And the idea is that you have multiple areas where people are going to be looking for support and resistance in this area. And you can see, and it doesn't have to be like a perfect diamond. Like this is diamond enough. You could call that a channel as well. So this is kind of one of those things where, you know, this is an hourly chart on Ripple, but this is kind of one of those things where, you know, there's a little bit of artistry, but what it does show is that you've seen a lot of noisy trading, and traders have decided that it was time to go in the other direction. This is a 20 EMA. This is used a lot on shorter term charts. And you can see we broke out of this box and broke this high here and continue to go higher. There really was no reason to think that things weren't going to change. And we had a spike here. Now, the question is, where do you put your stop? We put your stop on the other side of the diamond. So in this case, it would have been back here. You would have got in here. And then you're looking for the next major resistance area at the very least. And that's exactly where we ended up going. So Apple formed a bit of a diamond bottoming pattern a couple times, really. And that's the problem you're going to run into with this pattern. If you're not careful, you'll find it everywhere. It's not the cleanest pattern in the world, but basically what you're getting out of it is there's an area consolidation and you go higher. This is one that I found a little bit more tempting, mainly because you're in a situation where you have already started to make the move higher, and then you came back and you kind of consolidated in this little area and took off. Moving average, we'll go ahead and put that on. We'll make this, we'll make this is the daily chart. So maybe we'll go with the 50, get an idea where the 50 is at that point. So that is sitting right there. We used it as a trend line. So when we broke here, we went to this next resistance barrier. But notice we broke through it, kind of consolidated a little bit, and then took off. So you could make an argument for that. Now, this little area here, traders will have been watching it due to the fact that it was 50% Fibonacci, um, was tested and the buyers came in. So makes sense. Plus, there's also the bit about Apple as a Wall Street darling stock. So if the general stock market's going higher, it normally will as well. Now in the Forex world, we see these also. This is a diamond bottom pattern here in the New Zealand dollar. Notice that we're right here at 0.68. That's an area that's been important more than once. We formed this and we took off. This is a daily chart again. So let's go ahead and put the moving average on. And this case, we'll do the 50 again because it is the daily chart. You can see that we broke above here, broke above the 50. That was another reason. Again, the 68 cents level seems to be important in this chart. It's an area that had been tested a couple times previously, and therefore not a huge surprise. Plus, when you look at this, you know, you're talking about consolidation, support and resistance. It's really well defined. So, you know, there's a whole section or a whole video on that type of trading as well that we'll look at here a little further into the class. But right now you can see this was a reasonable signal. It was right where you had seen traders come in and support the market previously. So, you know, it's somewhat of an esoteric pattern, but really at this point, you have to look at it through the prism of, is it on support? Is it a consolidation area? Have we turned around, maybe broke above a moving average? In the next video, we'll take a look at the bull pennant pattern. Hello and welcome back to the chart pattern trading masterclass by Wealthy Education. In this video, we're taking a look at mastering the bull pennant pattern. So a bull, meaning bullish, meaning positive, pennant pattern occurs in an uptrend, the market rallying, and then you run into a little bit of consolidation with a couple of trend lines, suggesting that in the midst of a run higher, you get some sideways action that is tightening and tightening. And once you break above the top of the pennant, and you can see it looks like a pennant, it continues the upward pressure. Now, the nice thing about this is that you can use the built-in measuring stick. So, for example, if the pull of the pennant, the initial run higher before you get the consolidation, let's just say it is $12. Well, on a breakout above the pennant, you should get $12. You put your stop loss on the other side of the pennant and you take it from there. So let's take a look at a couple of examples. Here in Netflix, you can make an argument for a pennant here. So we broke above the top of the pennant and we did get our target. Now it pulled back. It took a little bit. Interestingly enough, in this example, notice that it also, once it broke through this, it actually became a W pattern or a double bottom. So kind of an interesting look there. Go ahead and take a look at Forex. Euro Japanese yen. We have That bullish pennant. Notice that we pulled back to the 120 level, and 120, of course, is a large round number. A lot of times these numbers attract a certain amount of attention. You can also open up the 50-day EMA, and you can see that we bounced from there. So the question is did we get our target? Well, we did. It took a while, but we did in fact get it. We almost got there right after the initial breakout, but you can see that if you put your stop loss underneath the pennant, you were never in any real serious trouble of getting stopped out. And finally, let's do crypto, and let's do something. Let's do near protocol. Okay, so here is a pretty messy pennant, but it is a pennant. You could, I suppose, look at it through the prism of, although I don't like that as much, truth be told. So, you've had that run. So you get this hole here. And notice that you did hit it eventually. Again, very choppy. Crypto tends to be very technically driven like this, but it also is extraordinarily volatile. So you also have to keep that in mind as well. So let me drop down to like the hourly chart in Solana. And get back to where, there we go, right there. So a little bit of a pennant right here. Nice flagpole, right? Break above the top of it, and you go directly there a few hours later. You're using the 50 EMA. And it should be noted that when you broke out of that pennant, you're right at the $40 level. So that attracts a certain amount of attention. You're in a kind of a consolidation grinding area here in the middle of an uptrend, a very choppy and noisy one, admittedly, but definitely a big move higher. So you can see these are pretty neat patterns. They're pretty straightforward. The idea, the psychology is that the market's going higher, right? And then you get this kind of consolidation, and eventually people who wanted to get involved here, once they see momentum, will jump in. So it's a matter of kind of working off some of the gains, working off the froth, if you will, after the initial move higher, and then having another reason to get in. And when people, say you're down here and you're watching this market do this and you see it consolidate and it takes off again, well, you want to join because you see that it's in an uptrend. And that's kind of what's going on here. Again, don't forget you have this nice measuring stick. So, if this is $12, this should be $12, et cetera, et cetera. So in the next video, we're going to actually take a look at something that's almost identical. It's called a bullish flag. It's almost an identical pattern, but instead of a triangle here and tightening consolidation, it's a little looser. It's also a little bit more common, at least for my observations. Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll talk about mastering the bull flag pattern. So a bull flag it's going to be a lot like a pennant. There's a move higher. So instead of tightening up into a triangle, you get a little bit of sideways consolidation. And you can see how people say it looks like a flag, or drawn out, it would be something like that. And then you take off to the upside. And it's done the same way. I mean, it's the exact same thing as a pennant. Flags catch a lot of people's attention, and therefore pretty useful pattern. A lot of people out there see it. So here's a little flag here. You can see that the market was in an uptrend here on the hourly Binance coin chart, and you take the flagpole and extend it out, and there's your target, and that is exactly where we went. A couple other things that you could keep in mind is that the uh, 50 moving average is right there, and of course you can also keep an eye on like the 20. You can see that it is also right there. The flag pulled right back into the 20 and then kept going. 20 is used a lot of times on these shorter levels. And another thing that I would point out with Binance coin at this point was it was pressuring the $300 level. So once we broke above there, it made a lot of sense that the market had some follow through. With that being said, let's go ahead and take a look at a stock, and we'll do Tesla at this point. Go ahead and hide the moving average for the moment. And we had a little bit of a bullish flag, and in stocks, it's going to be a little noisier because they gap at the open a lot of times, but you can see there's a bullish flag there. And of course, clearly we got our target easily. You can see that we broke above the 20-day EMA. Let's go ahead and switch it to 50, and you can see that the 50 came in and offered support, so we started to expand from it, so it made a lot of sense. You also can take a look at your MACD. Notice how we dropped to the zero line and we crossed over again, and then the moving averages started to spread, showing nice strength. And you could have gotten out up here. So it all kind of works out quite nicely. Let's go to Forex. Dollar Canadian dollar. Very choppy range bound market most of the time, but this pattern appears here as well. This is borderline not being a flag. And the reason I say that is you don't want the flag to be too long. That's the same thing with the pennant. You don't want the flag to be as long as the pole. Let's put it that way. That one's pretty close, but you can see clearly we got that move right as we were in the middle of building up that flagpole. You can see that we crossed the zero line in the MACD, which of course is a pretty nice pattern, nice confirmation of the pattern. You could do an RSI, but I suspect you aren't oversold. Although the smoothing line, and a lot of people don't use the yellow smoothing line, but you can see that we had hit an oversold part right there just before we started to build up momentum. That being said, really the biggest thing to pay attention to, and this is almost always going to be the case with any pattern or anything else, is we are breaking above 125, 1.25. So that is something that you should keep in mind as well. Pretty straightforward pattern. If you understand the pennant, you understand the flag. It's just a different type of consolidation at the end of the stick, as it were. Next video, we're going to talk about a rounding bottom pattern. Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll take a look at something called the rounded bottom, and this is a pattern that takes time to develop. It's very much like the cup with handle, um, and in fact, you can somewhat use it interchangeably. It just comes down to uh, whether or not you get the handle. So, like in this example here, this is Axis Bank. You can see cup with handle. But without the handle, it's a rounded bottom. Now, depending on when you get involved, you may have a situation where at this point it's a rounded bottom. Basically, like I said, it's just the teacup without the handle. You could make that argument. The measured move is the height of the pattern, which clearly you got. That wouldn't have been an issue either. You can use some indicators to see, are we seeing a change in um, momentum? And I would say yes, especially once you get to here. We've broken the zero pattern. We dip back down here during what could be the handle. But once we broke out above the top of the bigger rounded bottom, we had a spread. We have broken back above the zero line here on the MACD. So let's take a look at, and let's do another stock real quick. So what you want to see is the more time spent, the better. So, for example, you could make an argument for a very choppy rounded bottom there. I don't like that as much, but just because it's so back and forth. But you could make an argument for a bit of a rounded bottom here, or you can extend it out to here. Either way, you would be looking for it to break this area. So let's just say you decide that's a rounded bottom, and there is a bit of artistry involved in this. Well, once you clear that area, you gap on earnings and you just take off. You get the range with absolutely no issues here in Alibaba. Um, this is a pattern that you will see in a lot of stocks more than anything else. But you do see it in other types of markets as well. So let me take a look at Target. Um, yeah, like so here's a rounded bottom as well. It is choppy along the way, but one way if you have questions about it, what is it? Well, pull up a line chart. Notice how it really is a rounded bottom. So again, you could try the RSI, but by the very nature that it moves so slowly, you very rarely get a signal on the RSI because the RSI is going to, think about it's about momentum. It's about overbought, oversold. Well, if it's taking its time getting down there, it's not really an oversold condition. It's just that buyers are starting to come back in. Now, one indicator that can be important, volume, at least in the stock market. You can see that we got a spike here and that kind of kicked off. And once we broke out over here, we spiked again. So pay attention to volume on the exit. You also, of course, would have, the usual suspects here when it comes to technical analysis. There's your 50-day EMA. We break above there, we use it as support, and we continue. So let's take a look at Forex. I don't know, let's just do Euro Yen. So you could make an argument for a rounded bottom there. We actually pulled back to it and rallied right around the 120 level. So that is technically a rounded bottom. It pulled back and retested. Could just be a breakout. And again, like, don't get too hung up on the specific, whether it perfectly fits the pattern or not, because the reality is if there are a group of people out there that think that it is one thing that's bullish, and there are a group of people out there that think that it's another thing that's bullish, well, it's going to be bullish. It really doesn't matter what name you apply to it. So here's a rounded bottom here. But again, you could also say cup with handle. Really doesn't matter. You would put your stop loss under this cluster here once it broke this level, and you can see clearly the dollar rallied against the Canadian dollar. MACD did cross the zero line there and then really started to take off on the breakout. So pretty straightforward setup there. Let's go ahead and take a look at, let's do a crypto here. Let's do Litecoin. Oh, there we go. Okay, so Litecoin rounded bottom, noisy, but it did get its target. Now, this is where you need to decide, do you want to put your stop loss back here? Or on the breakout, do you want to put it halfway? Because if you put it halfway, you may have gotten tagged there. Hard to tell, really. The volatility profile of the cryptocurrency markets do make these things happen. Are we in the midst of another rounding bottom now? Well, no, as I record this, because we are seeing so much volatility. The key to a rounded bottom is you want a lack of volatility, not an increase in it. So that's why sometimes these patterns, although they look like they could be, I don't know that I would call them a rounding bottom. A rounding bottom is a gradual shift in the entire thinking of the market. We are gradually turning our attitude to a longer term, more sustainable bullish rally. So that ends module 2. We'll take a look in module 3 at the most bearish chart patterns. Hello and welcome back to the Chart Pattern Trading Masterclass by Wealthy Education. In this video, we begin module 3, the most bearish chart patterns. This particular video is about the double top pattern. So if you remember, there was the double bottom pattern being a very bullish pattern. This is the exact opposite. It's basically an area on the chart that markets won't go above. So instead of a W pattern, this is called an M pattern by some people. It can happen on any time frame, and basically it just tells you that, hey, the market doesn't want to go up here. Now, granted, nothing's 100%, but as a general rule, once you break down below the bottom of the letter here, that's when you short it, and you should be looking for basically the same height as the pattern. So let's go ahead and take a look at a couple of examples. This will be really easy because you already have a general idea as to how this plays out due to the double bottom video. But notice here, we have a peak, and here we have a peak. So what does this say? This says that the market does not want to go above here. So it's a bearish signal. You would look at this through the prism of this M pattern here. And now that we have broken below it, you're looking for that type of move, that height of a move. So in this case, it's about $40. So 380 would be your target. And that's essentially where we stopped at the conclusion of that move. You put your stop loss on the other side, or, you can use other things. So let's take a look at the structure of the M pattern itself. Like right here, where we saw a big impulsive move lower, you could save yourself a little bit of risk. It's $10 lower here in the spiders. This is the SPY. This is the ETF that tracks the S&P 500 total. So you can see that the market has, certainly taken off to the downside at that point, and therefore, momentum really starts to work in your favor. So with that being said, pretty straightforward trade. So this obviously, like I said, happens on all time frames. As a general rule, with any technical analysis pattern, and this is no different than any other one. As a general rule, you have more faith in a higher time frame one. But again, like I said, they do occur in shorter time frames. So let me go ahead and go to, I don't know, like a 30-minute chart. So Here in dollar Canada, you can see very similar situation to the one we just saw. We saw a bounce, a rise, a pullback, and a rise. Now, these are, this is like 15 pips, 10, 15 pips of differential. Remember, in the W pattern or the double bottom, I said they don't have to be pip to pip or tick to tick or penny to penny, depending on the market. You want them somewhat close. This is probably close enough. There is a little artistry involved, and there's a double bottom, so it's the exact opposite. You could make an argument for this being a double top. You could kind of make an argument for that being a double top. Here's a big one. That's another thing too that a lot of people don't think about, but it's the time spent making the double bottom that sometimes makes it more interesting as well. So, the double top and then double bottom kind of functionality of this. So what does this tell you? This tells you this is a little bit more complex. So this tells you there's a lot of consolidation because, interestingly enough, when you look at this, you can look at this and say, okay, well, it's a double top, right? But you can also call it a double bottom in the middle. So is this a big W pattern? If it is, then isn't it bullish? Well, we didn't break out on top of it, right? We did break down below the bottom of it. So you can look at it through the prism of almost like a complex consolidation area. So this is very noisy, but you can make an extreme argument for a huge double top. When you break through this, you have to think that everybody between 132 and 131 now are losing money. It's one handle, 100 pips, and clearly you got that. So a little bit of a complex example I wanted to show you. You can also look at, you can also do this. You could have said, okay, well, that's a double top. That's a little cleaner, a little easier to see. So it just kind of comes down to how in the weeds you want to get. My personal opinion is you want to see something that is very obvious. So here's one in Chili's. There's a nice double top. And what do we like about it? Well, we like the fact that the moving average is crossed right afterwards. But what else we like about it is that it's right at the 30 cents level. Let me go ahead and get rid of these drawings. Let's add an indicator or two. So let's see. Let's do the MACD. You can see that we crossed over here right at the other side of this double top. So that's a good sign that perhaps it's time to start selling again. Let's head back over to the stock market and let's see Microsoft. Okay, so let's go ahead and move up to the. This is another example of, like I showed in the dollar Canadian dollar, you can say, hey, we just made a double top. You can even say we made a triple top, which is the same thing, but 3. You can say it's a complex pattern. You could even say, let me get rid of all of these. You can even say that, hey, this was a double bottom. But it didn't break to the upside, just like the other one didn't. So really, what are you looking at when you see this? You're looking at a double top. You could just call this the double top. Triple top, you counted this one, 1, 2, 3. A double top and a double bottom. Or you could just call this consolidation and could even make a rectangle out of that. Now, here's the thing. You don't want to get too far into the weeds with this, what you want to do is you want to understand what the market's trying to tell you. And what it's trying to tell you is there's a big fight between 320 and I'll call it 345 here in Microsoft. Well, once 320 gives way, you have confirmation of at least a double top and a break of this double bottom. Remember, I said early in this course that a failed pattern says something too. This little double bottom here failed. That means everybody who bought in here suddenly is very fearful. Remember, there's psychology involved. So on this double top, that's what you want to call it. Like I said, it really doesn't matter. It drops right down to the 200-day EMA as a measured move. I don't want to confuse you with this. I want you to think about what the patterns are trying to say to you. A lot of courses get far too technically driven and they don't make you kind of think about, sometimes the market screams, sometimes it whispers. In this area, it was whispering because it was kind of telling you, okay, so what's going on? Well, it certainly looks like there is some push and pull. You can do like an RSI. This may have been the tell right here. The RSI was in overbought condition. And then we started to drift lower while the market went sideways. So just something to think about. But double top patterns are great patterns. Same reason double bottom patterns are. Everybody sees them. And in these complex ones, if you know how to read them, you can really clean up because that's something that people don't see until later. They typically will stick to this double bottom here, something that's really obvious. And that's fine. There's nothing wrong with it. It just comes down to how conservative you are with your analysis. I just want to impress upon you that there's a certain amount of artistry in it as well. With that being said, we will go into the head and shoulders pattern in the next video. Hello and welcome back to Chart Pattern Trading Masterclass by Wealth Education. In this video, we're taking a look at the head and shoulders pattern. So the head and shoulders pattern, we talked about this in the inverse head and shoulders video. Head and shoulders pattern is just simply when the market does this. The idea is that you are in an uptrend and you see a move that continues the rising prices. We pull back, we rally again, pull back, and you expect to continue going higher like you do in an uptrend. But this time we fall. There's a shoulder, a head, a shoulder. Remember that there is a neckline that connects the two shoulders. So once you break down below that neckline, everybody in this pattern is losing money. You put your stop loss on the other side of this shoulder on the exit and you let it rip. The target is the height of the pattern from the neckline to the top of the head, but quite often you get more, but that's your minimum target. Also, by putting your stop loss on the other side of the shoulder, unless the shoulder's way up here, which that's not really a head and shoulders, you automatically lock in a higher reward to risk type of pattern. So here is polka dot against tether. You can see that the market had been falling, but look at this. This is the other example that I want you to see. We tried to rally, we rallied a bit, we rallied even more, and we failed. So even though this is in a downtrend, it's a confirmation head and shoulders of the overall market itself. Let's take a look at Forex. And let's do British pound and get rid of some of my previous drawings there. Okay, so here is an example of a head and shoulders pattern that you may not see right away, but once you kind of train your eyes to see it, you'll understand. So we started to rally. We rallied there, ahead, the other shoulder. We break through that neckline, and we're aiming for that same length. We clearly got it. and just came undone. So let's see. Let's add an indicator and see if the MACD told us something. Well, the MACD, you'll notice, did tell us something. It had divergence as we were writing to the upside. So this divergence showing weakening momentum, even though the price was rising. That's a pretty bearish signal. This is the daily chart. Notice that the 50-day EMA broke below the 200-day EMA right here as well. That would have been a candle probably later than you would have entered anyways. But it does give you the heads up. Let's take a look at a stock here. Let's do Coinbase, and we'll do it on a shorter time frame. I don't know if I'll have enough. Yeah, there we go. Okay. So we've been drifting lower. Again, this is a recovery. But there's your little head and shoulders. Not a huge one, but we did get our target, which also coincided quite nicely with that previous support level. That's on the 30-minute chart, so it shows you how it can happen. Here's the 1-hour chart. So this is what is known as a complex head and shoulders. So a complex head and shoulders, a normal head and shoulders might look something like this. A complex head and shoulders can have two shoulders on each side. Can have two shoulders on one side. The idea is, and really this is the key to the pattern, that you have a high that is followed by at least one lower high. So don't get too concerned about it, but that's a complex head and shoulders. A lot of people don't see them. But the great thing about this is you can make a little trend line. This is the 1-hour chart, but you can make a little trend line over these last couple of days. When that trend line gets broken, if you're paying attention to the trend line, as a different trader, you're a seller, right? If you're following the complex head and shoulders, you're a seller. Again, we like the idea of multiple signals, and the reason being not necessarily because we follow them all, just because that gets more people involved. Right here, you had the signal lines, the EMAs, or the moving averages on the MACD cross the zero line. Relative strength really never got over. Well, I guess it did get overbought there. So just a touch before we took off to the downside. But clearly this is a situation where the market's going to continue to see a lot of volatility, and volatility, when you start making all of these lower highs and stuff, typically leads to lower prices, just because people don't want to own it when it gets that noisy. Now, remember, we had talked about this previously about how head and shoulders don't have to be perfectly level, and this one wasn't, but you can see we definitely took off. So question here is, was there anything else to make us think about selling? Well, yeah, I mean, you've got a previous area of interest, and you can see it has affected price multiple times. So right about here, you can see high, low, high, low, high, low, high, low, right here around 116.5. That's where the head and shoulders occurred. Definitely got our target. Yeah, we didn't break down and change the trend, but it certainly shows you, at least in the short term, we were ready to give it up. So the next video that we'll talk about is a bump and run reversal top pattern. Hello and welcome back to the Chart Pattern Trading Masterclass by Wealthy Education. In this video, I'm going to take a look at the bump and run reversal top pattern. So a bump and run is basically, you have a couple of trend lines involved in it. So you have like an uptrend line, and this would be your main one. It's called the lead in. And then you get another one that's called the bump. So the market is chugging along and then it bumps higher. And then you have what they call the run, which is when it breaks down below the main. So basically, what you're seeing is you're seeing a trend, that may be going relatively straightforward. It's kind of chugging along, and then you get this bump higher, and then you break down. And once this trend line's broken down, you expect to find support here. But when you don't get it, that's a very bad sign. That's like a failure on multiple counts. Now, you hope to see that the market slices right through this. If it struggles a little bit, then it becomes a little bit murky, but you want to see it just kind of come right down. So let's go ahead and get rid of these drawings for now. Now, one of the cons about this pattern is trend lines. I don't want to say they're subjective because they're not. But if you look hard enough, you can find a trend line somewhere. Um, so, for example, I could draw it like this on Tesla, and you could call that a bump and run. It'd be a very noisy and sloppy bump and run. And notice how this trend line was tested again. So you have to be somewhat careful with this. You're kind of looking for not only this, but maybe some other things at the same time in order to confirm. I mean, you should always be looking for that anyway. But really, what you want to see is some type of huge deviation. So here's a reasonable trend line in NVIDIA, right? And notice how we just took off after that. Now, you could call this the bump trend line. We tested it and we fell through it and we just sliced through it. So, what do you really have going on here? Well, what you have is an acceleration of bullish pressure. And at this point in time, you're probably long the market anyways. But once you break this trend line, then you start to think, okay, well, has something fundamentally changed with the attitude of this stock? We drop down, we test this line, can't get back above it. And then we break through the main trend line. So, in a sense, this almost acts like the 200-day EMA for your longer term trend. This is the last vestiges of strength. You'll notice that NVIDIA, since then, dropped $80 a share. So it's not even that you're too late. I mean, we all want to be short up here. But the reality is it can't keep the longer term trend. And that's probably the best way to describe the crux of this. Like you get a little bit of mania and then you break down. And then the next thing you know, it's not even holding where it should, in theory, hold, right? So Bitcoin, again, the problem you're going to have with Bitcoin and all other cryptos, you're only going to have somewhat limited examples based upon the short trading history on most exchanges. But you would have an extreme version here on the 4 hour chart. I mean, this would be really extreme bump and run, but you can see that that's exactly what happened. We bounced from there, bounce, broke down, and then just crushed this trend line that goes all the way back several months. Go ahead and take a look at Ethereum. I mean, in a sense, you could say it here too with Ethereum, like going back basically ages in the world of crypto. You see this nice trend line here where things got out of hand. And then once the bubble popped, we tested this trend line and then tested this longer term support line, bounced quite nicely. Came back to 3,600, which you can see has mattered multiple times, and then broke through the major uptrend line. That being said, this is kind of one of those situations where you see this. And really, what you want to be looking at this point is a signal, maybe on a shorter term chart, trying to find those moving averages rolling over, et cetera, et cetera. So let's take a look at Forex. British pound, Japanese yen. This is a very volatile pair. So this is the kind of market you do tend to see these in because it's so volatile. So you can see where I wouldn't call this a bump because there was a little impulsive area there, but it didn't really sustain itself. Now this, on the other hand, you could call that. And you can see we fell this long-term trend line and then broke through it, and it's just been down and out since. Um, and in fact, it took. See, this is 185. Yeah, we haven't even gotten close to it. While it looks like it went back there, it's still 20 handles below. You can see how it lays out on a really stretched out chart. So this is one of those patterns. Um, the initial trend line breaking should have you thinking, okay, well, are we changing the trend or are we finding support? And then you look at the longer term support line and you say, okay, well, this is where the trend needs to hold. And if the trend fails here, then we have something much bigger coming down the road. So it's kind of hard to call it. It's not really a pattern. It's more like an observation. I mean, I guess technically it's a pattern, but it is a confirmation of a reversal of a trend more than anything else. So in the next video, we'll take a look at something called a diamond top pattern. Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. This video, we're taking a look at the diamond top pattern. So the diamond top pattern, which is just the exact opposite of the diamond bottom pattern, is when you have basically action like this after a big move higher. So the idea, of course, is that you're seeing a bit of volatility after a trend to the upside, and therefore a little bit of confusion. You can typically draw trend lines like that. It doesn't have to be an exact diamond. It can be a little elongated in one direction or the other. The gist of it is you want to see a lot of indecision after a lot of momentum. So in this Bitcoin chart, you can literally draw a diamond shape with trend lines. And that's exactly what this is all about. In this particular case, what's worth noting is that it was at a previous high. And then, of course, it broke down below the 50-day EMA. That has people thinking, hey, maybe the trend is shifting. And we went all the way down to that support level rather quickly. So you can see how that kind of played out. Let's go over into the stock market. Let's see what we can get into over here. So XLE, which is the energy sector, it's an ETF in the United States, and you can see it's been drifting quite a bit higher for some time. Now you can't call it this yet, but this could be a potential diamond pattern, especially if we break down soon, because you could make an argument that we're at a recent high. You pull up the MACD we just crossed, so that's a sign of weakness. Also, I suspect, relative strength just peaked into overbought as well. So this is something that you would want to watch. If we break down below this trend line, that might set up a pretty significant move to the downside. Could fall all the way down here. So that's an example of a potential diamond pattern setting up. You can see that there is a diamond pattern here. So again, it's a bearish diamond pattern because we had been in a major uptrend and broke through it. So by doing so, we broke all these lines, dropped right back down to support. You see that time and time again. And that is part of the reason why support and resistance is so important. It's also worth noting that the area at that diamond was right at 80, which had been resistance a couple of times in the past. Granted, we blew through there previously, but you can see how that kind of comes into the picture. And of course, crypto, not going to be any different than any other market. So let's take a look at Polkadot. And I will, since we don't have as much history in crypto, I will go to a smaller time frame. In this case, the 4 hour trend line there, trend line there, there, there. There's your diamond pattern. It's a 4 hour chart, so we can do 50. We can also do 20. We can take a look at those. So there's your 50. We broke down through it. You could also, since it is a crypto chart, pay attention to volume. Volume picked up over here, right in the middle of this, and then started to fall off of a cliff. And then, of course, another thing that I would bring to your attention is right around here, right around $24. You can see Polkadot had major support. And really, if you look at this, let me go ahead and hide all of this. But if you look at this, I'll put this back up now, and I move this to a line chart, it really kind of comes into the picture. You can see major support in this general vicinity. We collapsed through it. We came back. We tested it again, found that resistance market memory, and have just fallen off of a cliff since. So you can definitely see how that plays out quite handily. Pretty common pattern. Again, you're looking for a move higher, a little bit of confusion and choppiness. Typically, it shows that the buyers are running out of momentum. And then if it breaks back down, everybody who's long starts running to either protect their positions or cut losses. So in the next video, we'll take a look at the bear pennant. Hello and welcome back to the chart pattern trading masterclass by Wealthy Education. In this video, taking a look at the bear pennant. So you've already seen what a bull pennant is. It's an uptrend and then some consolidation in the form of a triangle. And remember that once you break out of the triangle, you are looking for the same move as the length of the pole itself. Well, I'm sure you can already see where this is going. A bear pennant, same thing. It's just in the opposite direction. So you're in a downtrend, you get a little bit of consolidation in a bit of a triangle, and you break down. As a general rule, you want to see the triangle break down before it reaches the apex to a point. I mean, in a perfect world, you want to see it at about 75%, but you don't always get that. You just take this pole, measure your breakdown from the bottom of that triangle, and that's your target. So let's go ahead and take a look at Tron here. So Tron against Tether, we ended up forming a bit of a bear pennant right here. You can see we broke through it, tested the into the pennant and fell. We got the exact move, really. That was pretty amazing, actually, like right to the number. A lot of times it'll go further, but you put your stop loss on the other side of the pennant and you just let it rip. That, in this case, gave you like a 6-to-1 ratio. For every dollar you're risking, you're trying to gain 6. I'd also point out that this flag was this pennant was the result of a breakdown through the 75 cents level, which obviously had been important. And notice that right here where we targeted was right to the next major support level. And then we turned right back around and bounced. It fell again. And that's where we're at currently as a take a look at this. So, again, as a recap, we broke through this level here, 7.5 cents, down to the 5 cents level. So it looks like Tron is continuing to test this. If it breaks down, you go looking for support. Ultimately, though, this is a market that formed the pennant. That was your technical signal through this breakdown. So let's go ahead and take a look at, well, let's do a stock first. We'll do the Qs. Remember, this is an ETF that tracks the NASDAQ. Basically, instead of trading the NASDAQ cash index, you are trading this ETF, and it gives you the same type of momentum. So you have a pole here, and you have your pennant there. And notice it did break before the apex, and you certainly got your target pretty quickly. So let's go ahead and remove these drawings. Was there anything else that told you that, hey, maybe this is a place to take a look at? Well, there's the 50. So let's go ahead, and this is the daily. Let's go ahead and put this on. This will be the 200. And you'll notice that we started to break through the 50. We formed this little pennant, and then we broke the 200. So that obviously would capture a lot of attention. And then, of course, the volume really starts to pick up. So that tells you something's going on. And even beyond that, let's take a look at the RSI. We were overbought for a while, actually. And actually, some divergence because price kept going up while the RSI kept dropping. So that, of course, attracts a certain amount of attention in and of itself. And finally, let's take a look at Forex. Get rid of the line that I have drawn. So here is the bearish pennant. Try to draw it a little better for you. And you can see clearly we got that. Notice that like right in the middle of it, the 50 closed or dropped below the 200. That in and of itself captures a lot of attention. 130 was broken eventually, so that would capture a lot of attention. Notice that we pulled back from the 200-day EMA, so that captures a lot of attention. You could also make an argument for, let's see if there's, okay, so this, if you remember, I talked about this. So that's the 23.6, not a major fib number, but it is where we bounce back to. But you can take this, we'll go ahead and take that off, but take that, remember 23.6 is there, and you take the most recent rally, and the recent fib is 61.8. So you have what is known as confluence with fibs. You have one overlying the other one. So people are looking at the big fib move. People are looking at that fib move. Both say, okay, this is an area where maybe we could run into some trouble, plus the 200. So it all kind of ties in together quite nicely. So again, you know, it's a bear pennant. It's the opposite of the bull pennant. You already understand that concept. You can see if you line enough things up together, you get 3 or 4 different reasons to take a trade, then that's what you're looking for. We saw that in all of these examples. In the next video, we'll take a look at the bear flag. Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll take a look at the bear flag. The bear flag, as I'm sure you can imagine, is the exact opposite of the bull flag. So you have a downtrend, and then you have a sideways channel consolidation, and then you have a continuation. You measure the length of the pole, and from the breakout of the channel, that is your target. So let's go ahead and get on it. You can see right here, bear flag, certainly hit our target. Matter of fact, that's pretty much right where we went to almost immediately. But I would also point out that the 50-day EMA bumped up against the 200, had a little bit of a false breakout, and then broke down significantly. I'd also keep an eye on this area right here. This is the Aussie yen, so it's the Australian dollar at 90 yen. Seemed to be an area that found plenty of support in the past, and now we've broken down. Furthermore, let's take a look at the MACD. Let's zoom back in so you can see it. Notice how we tried to rally, and the MACD, the moving averages, got to the zero and then crossed down again. Now, while that's not technically a textbook signal, it does show that momentum's falling apart, and that actually happened before the actual breakdown. So on a scale of 1 to 10, what does this add to this trade? Maybe a 2. But the preponderance of the evidence is what you're looking at. You're looking at the shape, you're looking at the moving averages, you're looking at slicing through this support level, you're looking finally at this. 90, of course, is a large round number. A lot of people would be paying attention to it anyway. So it all kind of comes together quite nicely. Of course, we have these in crypto as well. So let's take a look at Cardano. And as a matter of fact, I think Cardano, some of the best patterns in crypto, and this is only because of the lack of historical price action on most exchanges, is probably going to be found on shorter term charts. Now, obviously, you will see a lot more like in the stock market, that type of thing, as far as like history is concerned. But it all means the same thing. So we started to form a flag here, and we did break down there. Now, it wasn't the easiest ride once we got down to here, but your stop loss was here. You were never in any danger, even when it did come back just a little bit. Keep in mind that this is one of those artistic times. Let me go ahead and zoom in. You could have called this a bearish pennant as well. Just kind of depend on how you drew the line, because you could have drawn it like that, or you could have drawn it like that. Pretty much the same pattern. So honestly, it really doesn't matter what you call it. Keep in mind that what you're measuring with technical analysis is going to be the psychology of the market in general. So you're trying to get the general feel of the market. You can see that 102 in Cardano was an area that mattered multiple times. So again, makes sense that we had seen a breakdown and it actually stick. So let's take a look at Tesla. This is kind of an ugly flag, but it is a flag nonetheless. It's almost not a flag. And the reason I say that is because you don't want the pole to be swallowed up by the flag, but it was kind of close. I suppose you could extend it to here. Notice how we did get that target there. So it worked out quite nicely. This is the 4-hour chart again. 320, an area where we've seen support and resistance. So the fact that we pulled back to bounce into it before finding sellers, not a huge surprise, and so forth. So you can see the bearish flag works just like the bullish flag, except for going down, and pretty straightforward. It's got that nice measuring stick in it. You just put your stop loss behind the flag, or if you don't want to pin it, doesn't really matter. And you take it from there. So that is the last video in module 3. In the next video, we begin module 4, mastering range bound trading strategies. Hello and welcome back to Chart Pattern Trading Masterclass. In this video, we begin Module 4, Mastering Range-Bound Trading Strategies. And this video is called Mastering Range-Bound Trading Strategy. This is kind of like an overview of what you'll be learning in this module. So a range-bound trading strategy is going to be very important. For example, you can see that I have zoomed way out on the diamonds. This is the DIA. It's an ETF, trades like a stock in America. It follows the Dow Jones Industrial Average. And one thing that you should notice is that while it is generally in an uptrend most of the time, when you start to zoom in, you can see that we spend a lot of time going sideways. So you can come over here, click on your trend line tools, and either use the trend line tool or use the arrow, do a horizontal line. And I'm just going to plot them very quickly in areas that I think look like kind of sideways trading, because that's all range bound is. You're just in a range. And you can see that we kind of bounce around here, we bounce around here, we bounce around here, we bounce around here, we bounce around here. Now, over the longer term, we do go higher, but you can see that there are a lot of times when we are sideways. You can click on this brush here and go to a rectangle, and you click and then click again. You can see that during, let's see, between, say, the 6th of April, 2020 and May 27th of 2020, we basically just went back and forth. In an environment like that, you need to be thinking more range bound. Now, a longer term investor obviously buys and holds with these types of things. But a majority of the time, depending on the market, the average time for most markets to go sideways or in a range is going to be about 80%. Now, it's a little difficult to say the same thing about crypto, although you can see from a previous video I did for the course, we were range bound there, we're range bound there. Click on this rectangle, we're range bound there. So there's a lot of money being left on the table if you don't have the ability to trade back and forth. The general idea about trading range bound is that you are looking for back and forth scenarios. So if you are looking at a market that is doing this, what's going to happen is sooner or later, you are going to break out of this range that you're in. So you have to accept that. And you have to realize that you can buy, sell, buy, sell, buy, sell, whatever, maybe get 6 or 7 trades in a row in your favor. And then eventually you're going to break out in one direction or the other. This is what would be a rectangle. That's fine. If you get 6 wins and 1 loss, you're by definition going to be profitable as long as your money management is reasonable. There's also range bound systems that follow channels, and a channel is either like an uptrending channel like that, or the exact opposite, a downtrending channel. You're just following like a well-defined range back and forth in a directionality, but it all essentially means the same thing. It means that the market is kind of just churning. And there are multiple different ways to go about it. There's a lot of different indicators you can use. One thing that I would bring to your attention is that sometimes, and not always, but sometimes, you get like a partial rise and a partial fall. So I'm only using this example because it's here, but you can see that we had been pretty range bound in Bitcoin. But notice we rallied there and we failed. We didn't get back to the top. So that's your first sign that maybe something's not quite right. And another thing that I would point out is look at this rise. It was lower. So you're not testing the top of the range, and that generally suggests that you're going to get a break, in this case a breakdown. It doesn't have to be, but a lot of times that's like a little heads up, as it were. Sometimes range bound trading can be rather large. This is a dollar Swiss franc, and this is six handles, 600 pips. That's a huge area. But other times, you've got more like this. So it just is going to depend on the market. But what we're going to do is we're going to focus on support and resistance. We're going to focus on and what we can do with indicators and such. And speaking of support and resistance, you need to understand that the higher time frame support and resistance levels matter much more. They are not perfect to the pip, but right around here you can see that there's been both buyers and sellers. You come to look for some type of supportive candlestick. Let me hide the volume. Volume doesn't matter in Forex because there's no centralized exchange. Hammer here. Inverted hammer here, you break above the top of them, that's a sign to start buying. So we are seeing buyers in the dollar against the Swiss franc right where you would expect to see it. That being said, we're going to go into the actual patterns now, but I wanted to get you an idea of what we're actually looking at. We're looking at a scenario where the market is trying to determine which way it's going to go next. Can we break above the top of this area up here? Well, nobody really knows yet, but right now you're just banking that you're going to get back there. If you break down below here, then you have broken out of this sideways action and you start looking for support at lower levels, which would be somewhere around there, and that could become your target. All right, so let's go ahead and jump into this. The next video is going to be understanding bilateral chart patterns. Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we're talking about bilateral chart patterns. So bilateral just means two levels, support and resistance, and it can come in a lot of different variations. So you can have the rectangle, which is just pretty much a straight line, support and resistance. You can get like a broadening wedge at the bottom of a move or the top of a move, where basically what you've got is a situation where price is moving like this, and over here it'd be moving like this. So if you're going in a downtrend, when it starts broadening like that, it shows a lot of noise. It shows a lot of indecision. And that shows that perhaps things are not as strong as they had been in the trend. Just as in an uptrend, like a broadening wedge would look like this. Everything was fine. And then all of a sudden we get up here and things get really noisy. And that can show signs of hesitation. And then the final pattern that I'll be talking about is the triangle. Now the triangle comes in three flavors. There is the symmetrical triangle. There is the descending triangle. And there is the ascending triangle. So what do each of these mean? Well, while this signifies a potential reversal, this signifies just balance in the market. Sooner or later, you break in one direction. These signify, in this case, selling pressure picking up. And if you think about it, it makes perfect sense. You've got a situation where the sellers are coming in the descending triangle and getting more and more aggressive, pressing against what should be thought of as a pretty significant support level. An ascending triangle is the exact opposite. The buyers are becoming more and more aggressive. A symmetric triangle looks pretty much like neutrality. Now, with the triangles, you do want them to break out of the triangle before you reach the apex, hopefully by 80%. If it breaks to the upside in an ascending triangle, you measure the triangle height itself, and that's your target. If it breaks to the downside in a descending triangle, you measure the height of the triangle itself, and that's your target. Same thing with symmetrical, although it doesn't necessarily lean in one direction or another, but if that's $5 tall and you break higher, you're looking for a $5 run. Similarly, we have the height of the rectangle, which predicates the idea of a move. So if that's 10, that should be 10. And rising wedges, typically you're looking at least to the beginning of the wedge, but a lot of times that's like an actual trend change. So a little bit more loose with the rules there. Stop losses go on the other side of the pattern on the triangles and the rectangles. That's going to be much easier than a broadening wedge. So the broadening wedge, a lot of times you look for the last swing low or swing high, depending on which direction you're going. So let's go ahead and remove all the drawings here and let's take a look at some real life examples. Well, we can click on the brush tool, click on rectangle. And you can see we had been in a rectangle here in the dollar Swiss. False breakout, but notice how we didn't come back as low. So your stop loss being back here, you're still looking for, at the very least, you're looking for a doubling of the pattern. So you got that. Now, in this particular case, you could have moved your stop loss up. You know, when you first broke out, if you took that breakout, your stop loss probably would have gone there. You didn't have to go all the way down here because if it broke there, then it was probably going there. It just makes simple sense. We came back, you had a little bit of a scare, and once you broke out again, then your stop loss could go there. There's your target, and you can see we blew through it. Quite often, you will see that exact thing happen. And with this rectangle, notice how the 50-day EMA came into the picture and really kind of picked things up. So there is that as well. Let's go ahead and take a look at Kiwi dollar. So you can see that we had a triangle forming here of the ascending kind, and we broke out in plenty of time. And really all a triangle is, you have to think about it through this prism. It's just the buyers becoming more aggressive. We're hugging the 50-day EMA, and we really start to take off. Here's the thing, though. A lot of times these patterns can be multiple patterns at the same time. You could also make a relatively strong argument that, hey, this was also a rectangle. The height of the triangle, the height of the rectangle are the same. So really, at the end of the day, it doesn't make any difference. I just wanted to show you that one doesn't necessarily supersede or preclude the other from being reality. Here is an ascending triangle that failed. So a lot of courses will tell you, okay, well, it should break out to the upside. It doesn't ignore it. But the reality is failed patterns mattered too. This means the buyers just got blown out. So think about that. You know, there are a lot of opportunities out there if you kind of think about what you are seeing in general. Like you always want to put yourself in the shoes of the other traders. You know, what would you be thinking if you were long or were short this market at that moment? Here's a symmetrical triangle. So this was a 50-50 ball, as it were. We did end up going with the trend. That's more often than not the case, but it's not impossible. So you don't want to jump the gun. You know, you definitely got your measured move once we broke out of that pattern. Let's go ahead and let's go into the crypto world here. See what Tron has to show us. Here is an ascending triangle that most certainly worked out. right there at the 50-day EMA. Triple triangle. Nice move, quick counter trend move. Could have been the beginning of something bigger. You just don't know. There's really no way to know that. Polka dot here has a descending triangle right along the 50-day EMA. The MACD is nowhere near being positive, and in fact crossed over to the downside again, showing even more weakness. So really no reason to doubt the validity of this thing going lower. Now here is a wicked, nasty, huge broadening wedge. These are difficult to play when they're this out of control. But take a look at this. Tron went from 5 to at one point $50. It's a 10 bagger. So if you're already in this, and you may have been based upon numerous signals, you might want to get out, because what it's showing you, and I'll switch to the line chart, but what it's showing you is, we went from kind of very quiet to straight up in the air to now all of a sudden there's a huge fight. One way to think of it is when you go into a big move, or when you've had a big move and you go into an area that's much higher, you've expended all this energy to get there in the first place. So you start to ask the question, who's left to buy this? So that's one way to think about this, because that most clearly was the case in crypto in a big way. And Tron, of course, was no different. So the broadening wedge, I mean, they're a little bit more difficult to trade, but like in this case, once you shorted on this nasty candlestick, it came back, it tested this trend line and it failed. So really what you're looking for is a retest, and then you want to start shorting. So, I mean, you could have put your stop loss there. If you're a little bit more conservative, you could have put it up there at the beginning of this candlestick. And you can see that we got the height of the broadening wedge all the way down here pretty easily. We did come back at the beginning, down almost to the beginning of the rally, came back to the last bull market and have seen it collapse again. Not really a broadening wedge there, but you can definitely see how we ran out of momentum. A little bit of a rectangle there. Did it work? Well, I mean, it did. You got the move. You got the measured move out of it. I mean, there's really nothing to complain about there. So that worked. Just like the descending triangle that I can see right there worked. Okay, let's go into the stock world. So here's a question, and we don't know this yet, but is this becoming some type of broadening wedge in this area? It certainly looks like, I mean, when you look at and a lot of times a line chart can give you a bit of a heads up when you're looking at something. Okay, so we're looking way out. Let me get rid of the EMA even. We're looking way out on Apple. Notice this huge volume swell here we took off. Now their volume swell there. And this was without the candlesticks, but you can see, there's a huge triangle there. Have we reached our pattern height? I don't know. Let's see. Yes, looks like we have. Okay. So we have, and once we got there, notice how noisy it is. And that is one way to think of, like I said, broadening wedges. And this would be, I think it's a little early to call this a broadening wedge, but this would be a nasty one. Clearly something's going on. So I would assume that if you were to break down below this trend line, things could get pretty ugly. You would have to assume at least down to 110 where you had seen support previously. But in this move, I mean, the next major support level is all the way down to 60. Now, if Apple drops to 60, that's horrific. Not saying it's going to happen, but it is something worth watching in this case. Notice how volume, it's steady, but it's a lot lower than it once was, which is kind of interesting. Remember, low volume preceded by a breakdown or a breakup with higher volume typically means that the move is going to matter as well. Let's go ahead and take a look at another stock before we move on. Microsoft. So pretty straightforward rectangle here. You could even say it's a rectangle top. We got our move. And the thing about rectangles is a lot of times you can go through a chart. And this is why knowing range bound trading is so important. Notice how you're in this box, you go down to this box, you go down to this box, you go up to this box, and then you fall back down into this box, and you're in this box. So the question is, do these matter previously? It's kind of poorly drawn, but you can kind of see where I'm going with it. I mean, these areas aren't mistakes. They're areas where people want to own a company. You know, like somebody out there put in a huge order and said somewhere around $220, $215, I want to own Microsoft. They said it then. They probably still believe it now. So that's why these occur. You could use like some of these kind of like partial rises and partial falls again to kind of get an idea as to where a market may go, just because, you know, like, okay, so here we were in a rectangle, right? And as you extrapolate it out, we couldn't get lower. So that shows we're starting to lean to the upside. The great thing about something like that, a breakout like that, again, is that you can just put your stop loss there. So if you're measuring this, and this is about $30, so you're looking to about 260 would be your target. By putting your stop loss under these area right here, under this pullback that did not get quite as far down, you're automatically making it about a 2-to-1 trade anyways once you hit the target. So it also helps with your money management, I guess is one way to think about it. There are indicators that you can use. So let's take a quick peek at that because you already understand the indicators, but let's go ahead and take a look at the MACD. So notice right here, we started to go positive, but we're just kind of like right here, we rolled over. So if you wanted to short this, you could have. Although heading into that, you might be a little bit nervous due to the fact that it didn't go as low. So you got to be at least somewhat guarded. We crossed here and then we eventually broke out. You know, down here, we crossed at this low. It's at a previous support level. So that probably got you in. Here, you could see some resistance. You pull back here, you crossed again. You're a buyer. Here, you would expect resistance. You didn't get, you know, so you could have been a seller there. You didn't quite get the move there. So it's time to start thinking, okay, maybe we're going higher. And then when you look at the longer term trend, I mean, you do expect eventually it picks back up. It doesn't mean it has to then. It's just like here. I mean, if you're a longer term investor, you're still looking to the upside. You're just not looking to it right now. So we're going to really kind of dive into the triangle patterns in the next video. I'm going to, you know, this was still a little bit more of a 30,000 foot overview of these. I'm going to really start looking at the indicators and kind of piling everything into triangles in the next video. Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll talk about mastering triangle patterns. So there's 3 types of triangle patterns, and I did touch on these earlier. There is the symmetrical triangle, which just has a couple of trend lines where the momentum of the market is getting choppier and choppier. And this is considered to be a neutral consolidation pattern. Basically, buyers and sellers are squeezing, trying to figure out who's going to win the battle. You have an ascending triangle pattern, which is a couple of trend lines like this, where the buyers become more and more aggressive. In theory, you should go higher. And of course, you have the descending triangle pattern, which is just the exact opposite. The sellers are becoming more and more aggressive, and you should, at least in theory, break down from there. So, that being said, this is a relatively common um, trading pattern that almost everybody else pays attention to. And as a result, it does have a pretty high success rate. One of the best things about this is that you take the height of the triangle, and this is true with all of them. It doesn't matter the pattern. And when you break out of that triangle, that is what you're expecting to see to the, in this case, the upside, because the buyers are coming back in to the downside over here and either direction here. Pretty common pattern. It's a pattern that a lot of traders like. But I would also point out there is such thing as a failed pattern, and never forget that you can take a look at a pattern like this and say, "Hey, that didn't break down. That might mean something." It's also a falling wedge, which is a completely different pattern. But I digress. So a lot of times that's what you'll see is you'll see these patterns. They can be other ones as well. That's not really that uncommon, truthfully. So let me go ahead and go to the 1 hour advanced micro devices chart. And we have a triangle here, a descending triangle. So the sellers are becoming more and more aggressive. We did break back into it. So what you would do in this, in this scenario, you would have a stop loss over here. You would get in once you broke down. You did have it go against you a little bit, but never really anywhere you would expect to see any type of trouble. And the measuring stick, of course, is the height of the triangle. And you can see that we easily had that. So it ended up being more or less a 2-to-1 uh, type of trade. Was there anything else that we could pay attention to? Well, the 50 EMA, and sometimes on a shorter time frame, you might want to use something more like a 20. You can see started to shift lower. So that's worth noting as well. Um, by its very nature, being somewhat range bound, your oscillators probably aren't going to do much for you, though. Let's go ahead and take a look at a Forex pair. Let's do the Australian dollar. And I will switch over to the daily. Let me get rid of some of these drawings that I had. And let me hide this for a minute. Okay. So you had another triangle to the downside. Clearly got our target there. Let's go ahead and take a look here. Here's your triangle to the upside. Put our EMA back on. You can see it dipped in there and then took off. No reason to think there was any serious trouble with that. Let's go ahead and put our MACD on. Go ahead and zoom in here a little bit. You can see that we crossed right here at the bottom and then took off to the upside, crossing the zero line right around the same time. Okay, let's go over to crypto. And let's do Ethereum. Let's go to the 1 hour. Symmetrical triangle. Let's go ahead and change this to the 20 here. You can see it's kind of falling right along. It goes into hyperdrive to the downside once we break through this bottom trend line. Not a huge surprise, really. I mean, we were in a downtrend to begin with, so why would anything change? You see what I'm saying? So, and a lot of times that's all symmetrical triangles truly are. Um, is they're just consolidation in what is a bigger move, but they don't, unlike the other triangles, they don't lean in one direction or the other, so you can't just go, hey, that's more bearish than bullish, because it very well could be the bottom. $3,000 was an area that offered support. Once we broke through that, that really kind of put the pressure on Ethereum. Nice move, just waiting to happen. And you can see we clearly got our breakdown to where we were trying to go. So, triangles really common. A lot of people like them. So with that being the case, they are most certainly worth paying attention to. In the next video, we'll take a little deeper look at broadening wedge patterns. Hello and welcome back to the Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll take a look at ascending, or we'll master broadening wedge patterns, but we're going to take a look at ascending broadening wedge, descending broadening wedge, and right angled broadening wedge. So basically, it's just a couple of trend lines. You've already seen me talk about these, where this would be an ascending one because price is going higher over the longer term. This is actually a bearish formation. And this would be a descending one, which shows price going lower like that. It's actually bullish if you break to the upside. And then there's also the right angle broadening wedge. Just means one of the lines are at a right angle. So if you were in an uptrend and you start to see this, and then you break down, that would be extraordinarily bearish, and of course, vice versa. The right angle ones are a little less common, but they do attract a certain amount of attention. So here's Polkadot, and you can see that we most certainly are starting to broaden the range here. A little bit of a right angled broadening wedge, and we broke down through it. Notice how we tested this as previous support, now as resistance right at the $40 region. Now, there's a little bit of controversy here because you have to ask, was it the wedge that kicked all this off, or was the breakdown below 40? At the end of the day, it doesn't matter. You have the 50-day EMA dropping below there on the 4-hour chart here, Polkadot, suggesting that we are breaking down anyway. So with the 50 EMA dropping down through 40, price coming down, testing it and failing. I mean, you have multiple reasons to be in this trade, and that's exactly what you're trying to figure out. Notice we've been in an uptrend, but everything all of a sudden starts getting a little tougher. Just as right here, we had a broadening wedge, wasn't a right angle one, but notice we never broke down below this trend line. So it didn't kick off a selling opportunity. It just kind of, everything calmed down and we went back to it. But as soon as you break down through the major support, you're off to the races. So let's take a look at, well, let's do Doge, see if we can find something here, because Doge is such a chaotic market anyway. I mean, this is an extreme example of it. I kind of figured it would be pretty extreme when I found it, of a broadening wedge. Now, this is a great example to talk about how you would enter, where you would exit, kind of thing. There are different ways to look at this. Most of the time, when I short something like this, I put a stop loss below, like right on the other side of the last failed attempt. So if this were going lower, it would be underneath the last pullback. As far as a target is concerned, you should be looking at the bottom of that wedge, and that's exactly where we ended up. So, really ugly, wild example, but gives you an idea of kind of what you're looking for. Let's do Google and or Alphabet here. Let's go to the daily chart. So, in this scenario, this isn't a typical wedge, but you can make an argument for a wedge here. Really, and again, at the end of the day, what you're looking for, this isn't even an ascending wedge, nor is it a descending wedge. It's just the wedge. Really, what you're looking for is price to squeeze um, in an uptrend like this and then start going all over the place. What that shows is volatility. And that's really what you're playing here. So, for example, you could make an argument for a wedge there. Now, notice I'm saying argument because there's a certain amount of artistry involved in this. So, there's a wedge here that we break out of and we go to the upside. It's a descending wedge because price is dropping through most of it. Um, I mean, I suppose you could probably draw it to there and it becomes a little bit more tidy. But don't the biggest thing I would tell you is just don't get caught up on the exact tick. I think that's where a lot of traders really fail at their technical analysis because they'll say, well, it broke here by 3 ticks or whatever, so it invalidates it. And I think you really kind of ruin your chances of success. You could even call this a right angle. See what I mean? Like there's a lot of different ways that you could go about this. Um, you could say, okay, well, it didn't close above there. Like some people wait for a close above to consider it broken out. So there it would be. MACD crosses over in that same general area as well. I cannot stress enough, and in this case, maybe I should probably say this too. In this case, this would be your stop loss. So it's about a trend change here. You'd be looking at the next resistance area. So that's about 2-1. And it ended up actually being 3-1. Now, I cannot stress this enough. Most of what you're looking at is the way people feel about a market. We obviously in Google had been selling off pretty quickly there. You go back to the line chart. We'd been selling off pretty quickly there, pretty steadily, and then all of a sudden it got choppy. Well, choppiness a lot of times shows indecision. It's a form of consolidation, and that's really all a wedge is, a broadening wedge is. It's a form of consolidation. It's consolidation with a wider range of volatility and momentum. So that's one way to look at it. A lot of times people will actually, speaking of line charts, they will use line charts to find these types of patterns because they focus on the close because the line just plots where you close. Well, when you draw that, it becomes much clearer. So that's something to think about as well. You want to always have a couple of reasons to go with a trade. And the most obvious one here is, I mean, we broke above the 50-day EMA. The 200-day EMA did get broken above, but even there you had the golden cross where the 50 breaks above the 200-day EMA. That's very bullish. And then, I mean, look at the chart. Which direction do you want to be trading in the first place? So when you think about it through that prism, there are some assets you don't really want to be a seller of for the most part. Google's kind of one of those. Now, is that changing in, as I record this in 2022, late 2022? Maybe, but probably not. I mean, it's going through, it could go all the way down to 70 and still not change the trade or change the trend. Yes, it's been in a nasty pullback, but look at the trajectory. So that's another thing to think about as well. Does your, maybe not 70, maybe 75, does your pattern line up with the longer term trend? So if that's not the case, then you have to think of it more or less through the lens of a trade. If it is the case, like back here, you can think of it more along the lines of a long term trade, in this case, an investment. So do keep that in mind. Let's go ahead and go over to Forex real quick. See what we can get into over here. Um, Argument to be made right here for a right angled broadening wedge goes with the trend. Once we break that high there, you get long. You had the 50 cross above the 200-day EMA. You also, shortly after that, broke above the 80 level. Now, having said that, um, there's a whole host of reasons to think, there's a W pattern. I mean, there's a whole host of reasons to get involved. But the great thing about this is you're looking at this through the prism of a bunch of different people at the same time. So always keep that in mind. So in the next video, we're going to talk about mastering rectangle patterns. This is something that you will see quite a bit more on the chart. So you definitely want to be pretty good at it. Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we're talking about mastering rectangle patterns. Now, a rectangle is just simply an area, and you've seen this multiple times through this course now, where you have support and resistance that's clearly defined in a bit of a parallel channel, if you will. So pretty straightforward. Price just goes back and forth. You try to figure out which direction it's going to go. And there's a whole host of things that you can do in order to facilitate trading these. As a general rule, when you get a rectangle on a breakout, it should move the same distance as the height of it. So if it breaks down or up, kind of irrelevant, it is in theory going to go that distance. Rectangles are neither positive nor negative, although statistically speaking, most consolidation leads to continuation. For example, if you're in a downtrend and you reach an area where you end up forming a rectangle, then you expect more likely than not could go around, but there's also the rectangle bottom, which could send it to the upside. So keep that in mind. So let's take a look at a couple of examples. Here in the dollar Swiss, you can see that there is an area of resistance right here at, basically parity. And then there's a level of support right here at 98.50. And, keep in mind, this is a daily chart. So that's quite some time. That's several weeks. And then we broke down. You break through the bottom of it. You're expecting at least the height of the rectangle, which, we clearly got. Another thing that you can do is you can, when that does happen, you just put your stop loss below, or excuse me, above the most recent rise, below in the case of the other direction. And then you aim for your target. So that does give you a built-in kind of risk to reward scenario that you can live with. They obviously happen on all time frames, but higher time frames, of course, matter more. So let's take a look at the Kroger company. So this is a grocer in the United States, and you can see right here a little bit of a rectangle. You can even talk about a bit of a double bottom, but you can see this rectangle was broken out of obvious longer term uptrend. You can see right there at the 200-day and the 50-day EMA. You can also draw your rectangles using an actual rectangle tool in the brush kind of submenu, geometric shapes. So you can see it's there. In this case scenario, this is a daily chart. So one of the things that you can do is say, okay, well, once you're above that, just put a stop loss below the moving average or just these candlesticks. You're aiming for a move like the rectangle, you got it, and quite a bit more. And volume, you can see really started to pick up on the breakout and shortly thereafter. Let's take a look at crypto, Cosmos Korean won. So here is a rectangle that ended up being a reversal. And how did you see the potential for this? Let me draw this a little bigger just to make it obvious. Well, the most obvious thing is you kept banging around between 24,000 and say 19,000, but then all of a sudden you couldn't return to the top of the pattern, and then you broke down below the 200-day EMA, and volume is dropping, so that shows a lack of interest. Let's go ahead and let me hide the volume, make it a little easier to see. MACD crossed over right in the middle of this as we started to lose faith in Cosmos. So at this point, you can see it's just a simple play. And, none of this is really new per se. We're just kind of looking at this through the prism of what's going on in the bigger picture. Now, you could have said, well, that was a reversal because we rallied, but it's more or less a reversal of a correction. You could have also drawn a fib down to this area, 50%. Right on top of that as well. So it all comes together for plenty of reasons to think about shorting. Rectangles are pretty straightforward. They either work or they don't. You just wait for a close outside of it on a candlestick to play it safe. You don't necessarily, for example, if you have candlesticks or you have a move that's like this, you don't buy it on the very first second it gets above there. You want to see like a daily close on a candlestick above there to start buying. At that point, then it has a little bit more confirmation. So most of the time people wait for a candlestick close outside of the box, if you will, in order to start trading. So that concludes Module 4, Mastering Range-Bound Trading Strategies. At this point, we are at the end of the course. Just a quick note to thank you for taking advantage of this learning opportunity. The chart pattern trading masterclass is something that we hope you come back to time and time again as you further your trading career for refreshing your information and your trading abilities. Thank you again for watching, and don't hesitate to reach out with any questions.